Hi, everyone. Thank you for joining us. Let's just make sure. Okay. I'm Lauren Pryor. I'm one of the co-leads of our FIG M&A group, and I'm sitting in the Washington office in our financial services practice. And I'm joined by Steve Abrahams from Amherst Pierpont Securities, Mike Frantantoni from the MBA, and Jen Fuller from KBW. And we have a very full program. So I'd love it if each of you could just give a very quick intro, and then we're going to dive right into the substance.
Sure. So Jennifer Fuller, I'm a managing director in investment banking at KBW. We focus across the mortgage industry. So I bank mortgage REITs, single family rental companies, commercial lenders, mortgage originators, mortgage servicers, non-QM mortgage lenders, and we have an active fintech effort, including prop tech and a lot of research and events in that regard. So looking forward to the chat.
Great.
So Mike Frantantoni, Chief Economist at the Mortgage Bankers Association. I head up a group called Research and Industry Technology. So if you're not familiar with the MBA, we have about 2,000 companies as members. So in the single family and commercial multifamily, we also have a number of mortgage REITs as members. So thanks for having me. Glad we could do this today.
Thrilled to have you.
Good morning, everyone, or afternoon. I'm Steve Abrahams. I'm a senior managing director at Amherst Pierpont Securities, and I'm the head of the investment strategy group. We are a primary broker dealer with a big concentration in mortgages and other structured products. And many REITs, among others, are our clients. We're not really doing the investment banking side of the transaction, but we are trading and trafficking in various securities. So that's typically our point of contact.
Okay, Steve,
Take
go
it
to
away.
your slice. Take it away. We have a lot of substance, and I feel like things are moving like by the hour in the last week in terms of trends. So let's dive right in. Oh, and I should say, I apologize. Let's have a free-flowing discussion. So feel free to raise a hand or turn on your microphones if they're popped around if you have questions, and otherwise we can also take questions at the end.
Great.
Thanks, Steve.
Thank you. So I just wanted to provide a very high-level overview of kind of where we are with the Fed and some things that are important, at least in the economy. So one thing, obviously, is that the Fed has really grabbed the tiger by the tail, and that tiger is called inflation. And I do mean that the Fed has grabbed this tiger by the tail because where we are on the inflation front is in part due to some important decisions that the Fed has made over basically the last decade. Now, I'm sure a lot of you remember that for most of the last decade, inflation has been really remarkably low. And I do mean remarkably because for most of the last decade, call it from 2008, at least through 2015, you could argue even longer, the Fed was desperately trying to get inflation higher. Remember, for part of that, it was doing QE. It did have interest rates effectively at zero, and it really was not getting good results. It was constantly looking for inflation to pick up and get to what it believes is its target, someplace in the neighborhood of 2%, and it was having basically no luck. So, drum roll please, in August of 2020, it decided to take a new approach to managing the economy, as it were, with something called flexible average inflation targeting, which the main components of that was it said, look, folks, we're not necessarily going to promise you that inflation will always be at 2% or under 2%. We're going to allow inflation to run potentially well above 2% if we need to. And what we will tell you is that on average, if you look at inflation over many, many years, 2% is what you will get. The other thing that they said is that we are really going to start focusing on the labor market. So we're going to be completely comfortable if the labor market looks like it's tight, where there are far more jobs than there are people. And only when we get to that point are we going to decide to start kind of cooling the economy a little bit. So voila, they introduced flexible average inflation targeting just in time for the first massive fiscal stimulus in at least 12 years. That's with the CARES Act and the various other rescue packages that followed. It was also the rebound from COVID, which instead of looking like a more traditional recession, was probably closer to a natural disaster. And so the combination of the Fed allowing policy to remain very easy, to continue QE effectively until this month, along with fiscal stimulus, tightening labor markets, and all the other things you've read about, bottlenecks, and so on and so forth, has led us to where we are on the inflation front, which is some of the highest marks that we've seen in 40 years. Now, where are we going from here? Yesterday was a big day, at least for the Fed part of the market equation. And some of you in your printed books have an earlier version of the slide, which shows kind of the way the world looked, at least through the Fed's eyes, in December of last year. That was the last time they came out with their dots, which basically is telling the world, here's where we kind of expect things are going to play out. And their dots, their view of where they would need to push rates before yesterday was way, way, way lower than what we saw yesterday afternoon. In fact, at the end of 2022, in their dots from December, they expected Fed funds to be under 1%. Now, obviously, you can see in the chart up on the screen that the dots, that's the blue line, now have Fed funds at the end of this year in the neighborhood of 2%. At the end of 2023, the Fed's dots in December were, call it 175, and now they are closer to 275. So that was another huge revision in the Fed's view of where it was going to be going over the next couple of years. And the important thing for the folks that are really looking at the details of what the Fed does and talks about, that was the first time the Fed said, folks, we're really going to push rates up, and we're going to push them above what we believe is kind of the neutral rate. And in the Fed world, neutral means the rate where kind of inflation is where you want it to be, where the economy is not too hot, not too cold. It's kind of a Goldilocks outcome. So that was the first signal that the Fed was going to really tighten, which frankly they've needed to do for quite a while. It's almost impossible to reduce inflation, traditionally at least, without pushing Fed funds above neutral. And so finally they said, yeah, folks, that's exactly what we have to do. I think we saw in the markets yesterday parts of the Treasury curve invert, so shorter yields were higher than longer yields. That's something, frankly, that we thought starting in December could be in the cards. The case for it's gotten progressively stronger. Our view is that even today, the market is still underpricing the inversion that we're likely to see in the Treasury curve. And this, in all likelihood, isn't just going to be kind of a polite inversion. This is probably going to be one of the more aggressive inversions that we're likely to have seen, arguably since the 90s. They also started talking about reversing their quantitative easing. That's been a huge part of what they've been doing as well, pouring money into the economy. That ends this month. And in his comments after yesterday's FOMC, Powell basically tipped his hand that May looks like the point where they're going to start allowing their balances, their Fed portfolio balances to run down, which people are now calling quantitative tightening, which is a fair way of thinking about it. That could be 30 billion in MBS to start, 30 to 40 billion in treasuries to start, which is a very bad technical for the mortgage market. And the market has started to price that, but the market's still potentially on the mortgage side, which I'm sure is an area of great concern to everybody. It's very, very likely that spreads are going to continue to widen, mainly because there's no obvious buyer for all of this paper that's going to come into the market through the Fed and through just the natural uptick in outstanding mortgage debt. Basically, over the last 2 years, the only net buyers of MBS has been the Fed and banks. and both of them are pretty much linked by the same dynamic. The Fed pumps money into the economy. That money typically ends up on bank balance sheets. Banks pay to hold that money, so they have to reinvest. Banks and the Fed have really been the only net buyers. Now they're going to both start heading in the opposite direction. There's no money coming into the total return community, mutual funds, ETFs. They've seen significant net withdrawals this year. So everybody's looking for the next buyer, and so far nobody's really holding up their hand. Next slide. What does the market think about the Fed's odds of taming the tiger? Actually, pretty good. Pretty good. So what you're looking at here are measures you can derive from the TIPS market. That's the market that effectively prices inflation. And it shows you the implied inflation over different horizons. The highest implied inflation mark you're looking at is for 2 years, which I want to say is in the neighborhood of, in excess of 4.5%. So a lot of people think, oh, the market's getting surprised by these big inflation prints. It is to some extent, but the market has really anticipated that we were going to see very, very high inflation. I mean, a large component of that is fairly predictable. What's more interesting is the lowest graph, the lowest point on that graph. That's the yellow line, I believe. And that's implied inflation 5 years from now. Yes, that's exactly what the debt markets do. They're really trying to price risk over a very long horizon. And the debt markets are saying, well, okay, we may be 5.5 plus over the next 2 years, but 5 years from now, the outlook is, call it 2.5, and it's obviously been a little bit lower. 2.5 is actually pretty much in the neighborhood of what the Fed could live with. So the market still has tremendous confidence in the Fed's abilities to beat this inflation surge. And it may not be pretty, but the Fed has the tools and they have just started to use them. And the question is, are they going to be able to do this the easy way, in which case inflation comes down gently, the economy slows, unemployment probably goes up a little bit, but isn't catastrophic? Or are they going to end up doing it the hard way, where we have a significant slowdown in economic growth, much higher unemployment, and much more volatility? Historically, hiking Fed funds is a blunt tool. I mean, remember, you're not trying to thread the needle of just the mortgage market or just this sector of the economy. You're really trying to cool off economic demand broadly defined. And as the Fed, or at least Greenspan, like to say, monetary policy works with long and variable lags, which is a polite say of saying, hey, folks, I hope we are getting this right, but you never know. So we're just at the beginning of that. Next slide. So the other thing that's interesting about this process is what's going to happen in the long end of the yield curve. And that's also going to be important, obviously, for the mortgage market, because at least for 30-year rates, the 10-year part of the curve is traditionally a key benchmark. And there's a very, very strong case that the long end of the yield curve is not going to go up by much. Now, one of the things the Fed also did yesterday was bring down its estimate of the long-term neutral rate. It was 2.5, and it brought it down to roughly 2 3/8. And basically that says that the Fed believes long-term growth in the U.S. economy, the achievable growth in the U.S. economy, is going to be kind of low. It's not going to be so strong that there's tremendous demand to borrow. So and that's measured by this real interest rate. After inflation, how much do people really pay to borrow money? So why is it that the Fed might expect that real rates could be low? Well, remember, real rates are the supply and the demand for money. So what about on the supply side? Well, we have historic central bank liquidity. I mean, remember, it's not just the Fed that's pushed its portfolio up, I want to say, to $8.4 trillion today. European Central Bank has been extraordinarily easy. Japan has been easy. So there's a huge amount of money sloshing around the global economy, and we are operating in a global debt market. There's also post Great Financial Crisis requirements for bank liquidity. So banks globally are a lot more liquid than they were before the crisis, and that liquidity typically has to get invested in very safe instruments. And then there's some real headwinds to long-term economic growth. And in fact, if you noticed yesterday, the Fed revised down some of its GDP expectations as well. And what are those headwinds? Well, there's slowing labor force participation. We've seen some of that induced by pandemic. There's also a demographic argument for that. There are limits to immigration that not just exist in the US, but now globally. And there are limits to trade. Everybody argues about whether immigration or trade is good, bad, or indifferent, but purely from an economic standpoint, it is typically the benefits far outweigh some of the negatives. And then the last point that I'd make is, which is on the next slide.
Oh, great.
Beautiful, thank you. So the last point that I'd make is that for what we're about to go through, if you just think about it from a credit standpoint, other major balance sheets in the economy, both corporations and households, are in remarkably good shape. And I think if you said to people 2 years ago, hey, we're going to have a global pandemic and how corporations and households are going to come out of it stronger than ever, people would have thought, well, you're crazy. But that's basically exactly what we've got. These are just a couple of measures, but corporations have shown record profits. So even though we've had inflation, the revenue line has gone up faster than the cost line. The margins in general have been quite good. Liquidity on corporate balance sheets, quite good. And if you look at corporate debt funding, corporations are largely inoculated against a rise in rates because many of them have extended their debt out to very, very long maturity. So a rise in the short rate of funds is not going to hurt them with a couple of sectors of the corporate debt markets. And then on the household side, obviously very well advertised, net worth off the charts, record by a long shot. Thank you to benefits of home price appreciation, portfolio appreciation, all of that, notwithstanding the last quarter of returns, has left net worth near record levels. Income, believe it or not, through the end of last year, continued to go up. Households have saved a tremendous amount of money that they received through federal transfers over the last few years. So there's a huge buffer of savings that's out there to allow most households to make it through any slowdown in the economy as well. So that's kind of the broad macro outlook, at least the way that we're seeing it, with lots of implications, but I'm going to let Mike.
We'll turn it over to Mike for the mortgage market outlook.
Exactly.
All right, thank you, Steve. So yeah, I'll just take that handoff, show you our macro outlook, and it rhymes with what Steve was talking about. So won't spend any time there. But if we go to the next one, what are the implications for a mortgage market of going from what were all-time lows in mortgage rates, as Anna said, to this morning, the Freddie Mac rate was 4.1%. If you look at market rates that others are seeing, they're closer to 4.5%. So if you look at total origination volume, the last 2 years, it was in the neighborhood of $4 trillion of originations per year. We have been forecasting and are holding to that forecast for now of about a 30% drop in total origination volume. If you look at those yellow bars, that's refinance, about a 62% drop in refinance volume. At the same time, due to a lot of the things that Steve was saying about a very, very strong household sector, coupled with very favorable demographics, which are leading to strong housing demand, we're forecasting growth in the purchase market of sort of low single digits. So how are we doing so far? Well, if you go to the next slide, forward. Yep, there you go.
There we go.
If you look at the red line, that's refinance application volume. It is down 60% compared to where we were last year at this time. So pretty much in line with what we were forecasting. And if you look at where we're likely headed, I think not too long we'll be back to the level of refi volume that we had in a year like 2018, which is a purchase-dominated market. And for those in the mortgage industry, remember, a very tough year to be a mortgage lender. Go to the next slide. You might think, well, people have so much equity in their properties. Maybe this is the year they begin tapping that equity to a greater extent, either through cash out refinances or through various means of home equity lending. This is just looking at the share of refinances which are cash out, and that's certainly going up, but the total volume of cash out lending, about roughly steady. It's mostly those rate term refinances that have fallen away. So not sure this is really going to be the thing that's going to bail a lender out this year, just because so many people, if they got that 2.7 30-year mortgage in 2020, really unlikely they're going to give that up to get some funds to finance a home improvement. They'll maybe go to a HELOC or a closed-end second instead, if not a non-house related financing. So refinance market really in the rearview mirror, given what's happened to rates. So let's move to what's going on in the purchase market. So we've been relatively bullish in our forecast with respect to growing home construction. News this morning, the February housing starts data looked pretty good. So on the single family side, starts and permits up a bit, certainly up relative to last year. And there's now about 800,000 single family homes under construction. On top of that, there's about 760,000 apartments under construction. You add those two together, 1.6 million, that matches the amount of households that are being formed at this period in time. We're finally at the point where the supply, at least, is not falling further behind after really a decade of underbuilding. Again, this curious result of pandemic experience is really leading to an increase in housing demand, which I think no builder would have told you was their expectation in March of 2020. Got us even further behind in terms of the supply-demand imbalance. So you look at the chart on the left, home sales in 2021, as high as we've seen since 2006. You see our forecast for modest growth in both new and existing home sales. This year, a little bit more growth on the new home side. Really, the constraint on even faster growth has just been the lack of inventory. So we look at that brown line, we're down to about 2 months of existing home supply. We'll see tomorrow if in February some current owners did move to list their properties at a greater speed than we've seen thus far. But if you look at that blue line, we got more than 6 months of new home inventory now. So builders absolutely moving in the right direction, even being constrained as they are by much higher costs for their inputs and certainly lack of availability of certain inputs. But the cost of inputs for a typical builder up about 20% year on year. So that is a constraint on the ability of new home inventory to continue to grow. But still, we're forecasting growth in single family home construction this year. But if we go to the next slide, to the point that Anna made, this imbalance, really results in sort of the biggest risk to our forecast of growing purchase origination volume and really a healthy housing market. So, most recent data points, depending on which index you look at, show 17, 18, 19% growth in home prices nationally year on year. That's a national number, which means you can find markets like in the Mountain West that are growing twice that fast. And even in the slowest growing markets in parts of the country that may face all kinds of, population and aging challenges, they were still growing double digits. So a very, very unusual year at a time when wages were growing sort of 5% at the fastest, right? So not keeping up with the 8% inflation, but certainly not keeping up with this pace of growth in home prices. So what's going to happen from here? So again, our forecast is we do get some additional construction, get a little more inventory, first on the new home side, and that should lead to some additional inventory on the existing side, just as people move. Quickly go back for 1 second.
Oh, go back. Yep.
Just
Absolutely, of course.
So I'm showing here what I would describe as an optimistic forecast, that we go from 18% home price growth in 2021 to something that looks like 5% by the end of this year. Optimistic because I think If that happens, our forecast for growing home sales, growing purchase originations will come to bear. If it doesn't, we run the risk of really, hitting an affordability wall sometime this year. So if I look at some of my competitors and compatriots out there, right? So we think we'll be at 5% for 2022. CoreLogic, a data company, thinks we'll be at 3%. Folks like Goldman and JP Morgan think we'll be at 12%. That's a pretty broad range of forecast for national home prices, right? It basically says we don't know what's going to happen. Let's just be honest about it. But what would it look like if our forecast was going to come true? Well, the chart on the bottom is just showing, well, if you annualize recent quarterly growth, it looks like we're getting a little bit of deceleration. Maybe we're tipping over the top. And again, we are seeing some additional new home inventory coming on the market. If we get the Goldman forecast and prices grow 12% this year, I'm really worried we're going to see a decline in home prices next year, right? I think that'll be pushing things too far in the realm of just running ahead of the first-time homebuyer demand we have. So with that cautionary thought, let's move on to the next slide. So purchase volume this year thus far, at least on a dollar basis, that black line compared to the green line, running a smidge ahead of where we were last year. So let's go to the next one. What happens in these kind of markets where affordability becomes a real challenge, where lenders, buyers, everyone in the market begins to stretch a little bit? Well, you begin to see more interest in things like non-QM lending, begin to see more interest in adjustable rate mortgages, other things that might just extend that purchasing power just a bit. I mean, the ARM share is at 5% of units right now, so still really low, but expect that's likely to go up. And I wouldn't be shocked to see the non-QM volume double this year, right? Which is from a low number to still a low number, but enough that sort of on the margin, you're beginning to help borrowers. But if we go to the next slide, thinking about, okay, good, what does this mean for a lender when you go from a $4 trillion market to a $2.6 trillion market very quickly? Lenders for 2020 and 2021, their biggest challenge was trying to staff up, and particularly staff up with back office and sales talent to meet the demand that was coming in their door. Not only was it one of the highest volume 2-year periods ever, but it was clearly the most profitable 2-year period for mortgage bankers in our data. But you can see this is looking at a margin on the production business, just how rapidly that came in. And so now, as of fourth quarter, we're at 38 basis points, where in 2020 we were as high as 200 basis points. And 38 is an average, right? You're seeing people in the industry already losing money on their origination business. You're seeing layoffs. You're seeing consolidation. You're seeing significant interest in M&A. Lauren, I think you're going to talk about that. When it had been quiet, when things were going particularly well. Last couple of thoughts, just a few data points on the servicing side. So if we can go ahead, delinquencies spiked with the pandemic, but have come down really very quickly, really in line with the unemployment rate.
That was another one that was surprising, right? We all anticipated it was going to be much greater.
Yeah. No, for most households, it worked really well. And if you go to the next slide, the big experiment this time was extremely broad use of forbearance. So at its peak, 8.5% of all mortgages in the country were in forbearance in June of 2020. We're down to 1.3%. So we still have about 650,000 homeowners in forbearance, but
tremendous decline.
Yeah, extremely rapid. We're also tracking the payment performance of these. It's generally looking pretty good.
Pre-COVID, what was the typical forbearance percentage for average?
It looked like 0.
Yeah. Way down on the left.
It was in tiny basis points. It would be a natural disaster here, natural disaster there for a few months, not 8.5% of all loans in the country. But again, the exits have been amazingly smooth thus far. You're left with sort of the tougher cases at the end, but very, very, very strong. So, as a result, if we go to the next one, This business, sometimes you describe as a natural hedge. When the origination business is doing poorly, the servicing business tends to do well. MSR values get marked up. We're seeing that in our data. And then last slide, just looking at MSR values. With so many mortgages being originated at extraordinarily low rates, and now rates moving up as quickly as they did, market expectation, these are going to be around for a really long time. So those servicing values moved up quite a bit. So with that, I will turn it over to Jennifer.
Great, thank you. Well, what I thought I would do is actually talk a little bit about the trends that Mike talked about, and the broader trends, and then talk about how that's actually filtering through to valuations in the industry, how people are thinking about strategic initiatives and M&A and JV, and try to make some predictions about what's going to happen in 2022. So on the first page. The first piece is really exactly what Mike just said about non-QM and other products. So mortgage volume is down, given loan officers have been under RESPA requirements that they can't be paid differently generally for different products. They are, and the supply is up in the industry compared to volume being down. They're more than willing now to focus on other products outside of GSE and government lending. And so their ability, it has been a challenge as non-QM has ramped up volume wise for those lenders to actually find the customers, get volume out of loan officers from, for example, from wholesale channels. And that's gotten much easier as loan officers. There's a lot of loan officers in the market, a lot of capacity, and they want to originate more. One thing that we will see in the mortgage REIT space, for example, is that from an investment perspective, generally these loans and investor-owned single-family property loans are still viewed as an attractive risk-adjusted return. And so industry participants with capital are not only interested in the assets, but interested in the platforms as a method to manufacture assets. And so I would expect that there is continued interest in acquisitions in that sector, people with capital acquiring folks that can actually manufacture the assets. The second piece is the GSEs are sort of pulling back. That gets to the same trends with the rising fees on investor loans as well as non-QM loans. So that market, it only helps it get larger, right? So the market is increasing. The other piece is, home prices staying up. Hopefully we don't hit an affordability wall this next year, but you're seeing these products have been around for a bit, but you're seeing somewhere between, you used to have forward mortgage, then reverse mortgage, and then you go all the way and you're renting a home. But there's a lot in the middle there that we'll talk about, products that either help people get cash to make down payments, help people straddle buying and selling, or help people get cash out of their homes. Those companies are often using technology and generating a lot of investor interest. Then the other piece is really sourcing the borrower, seeing two big trends that drive M&A and also drive what public companies are trying to do to get their valuations up. And I would put that in the broad trend of embedded finance. But what's happening is that the customers, the borrowers, are getting harder to source, and it's unclear to me why. But I think what I've heard from some industry participants is that the market's more transparent. People can do research online. People are familiar because of multiple refinances with the mortgage process, and so they are coming to lenders. They're shopping around, and the traditional internet leads are actually more expensive when it comes to client acquisition cost. And so people are looking to attach more products, and we'll talk about that as well. And then, the use of technology, as Anna alluded to, is a huge piece that people are using to either drive efficiency in their businesses or get new customers. And they're doing that through minority acquisitions as well as M&A. And then I'll talk about blockchain in just a little bit, because I think that's an emerging trend. On the next page, you've got this is the 1 year, looking 1 year back, the total return of public sector companies by mortgage and real estate finance and housing subsector. So at the In dead last, you've got real estate brokerage and mortgage origination for all of the reasons that we've talked about. You've got real estate tech that was just like the rest of the technology sector, was enjoying very high valuations, and it is not there anymore. And at the very top, you have single family rental, where historically multifamily rentals have been viewed as sort of an inflation hedge. And with home prices going up and inflation being high, that's been a big sector. And I expect actually you've seen mortgage REITs like Starwood and New Residential investing in single family properties, and I actually expect that there may be acquisitions across the number of folks that are investing in this asset class that still don't have robust internal property management and sourcing capabilities. I think there's a lot that those companies can do to bring those capabilities in-house. Somewhere in the middle, you have the residential mortgage REITs, negative, but not as negative as some of the others. And I want to talk about that in the next page. This graph shows you the price to book value of, as of Friday, of all of the residential mortgage REITs. And there are a couple of trends here that I think are interesting. One, I would say, credit mortgage REITs generally have been impacted by investors by widening credit spreads. That has hurt them. But what's interesting is that you have 4 of those companies that are ranked, number 2 through 5 on this page, that are very much exposed to credit. And I think one of those reasons, and this is something that my colleagues in our research department sort of share, is that investors have put a premium on mortgage REITs with asset generation capability. So you can't really see the logos, but underneath you have some logos for some platforms that these companies have owned or acquired. And so they do have asset sourcing capabilities that are embedded. And I do believe that that's a big piece of why the market is assigning, it's not a premium, it's a lower discount, but assigning a better valuation to them than others. The other thing, and I don't know that you can see it from the graph either, the way that how it's sort of formatted from where you're looking, but we have these sort of slanted lines for the mortgage REITs that have under $1 billion in market cap. And you see that the lowest price to book valuation for mortgage REITs are for those that are lower in market cap. They're less liquid stocks. There's a lot of volatility in the market, and I expect that this may drive more M&A as well. On the next page, this gets back to the concept of embedded finance and desire to actually own a customer. So 2 different things. It's one, how do we find the customer? Secondly, how do we expand the revenue that we're getting from customers? So if a company is, we're talking about going all the way up the funnel. So traditional purchase mortgages, our loan officers have relationships with real estate agents. You start, or you may have consumer direct, we advertise, we buy internet leads. That's getting more difficult. So now you're going up the funnel. Can we attach title? There are, you've got inspection. You've even got financial wellness products. You've got, I believe Zillow is trying to create a super app, right, for that is more all encompassing. And you're even seeing people going way up to get to renters, hoping to begin to own a customer that they can then attach more products to later. Once you close a loan, now we're going to, how can we use information that we collect on that borrower to increase our market share from that? How can we create algorithms that can better predict when they will refinance, purchase a new home? How can we better recapture that? How can we attach consumer products? How can we attach cable, security, what have you? Most companies are talking about, and that are in the public space talking to investors, attachment rates generally of 30 to 50%. Title has been easy to achieve. In practice, mortgage, unless you're a home builder, has been more difficult. I think most of those companies are very low on mortgage attachment rates, but also targeting the same general range over the next 2 years. So this is another factor that I think will be a significant driver of M&A. And on the next page, you have a lot of that. So this is M&A, and this is a selection of, this is by no means the universe, but M&A and JV from different industry players. So you have real estate brokerages that are buying mortgage lenders, title companies, doing joint ventures. This also includes technology companies. You've got Rocket that now has Lower My Bill. So now you're getting into consumer credit relationships with clients that would or may be mortgage buyers. You are getting to sort of, home services verticals, Porch, because of their sort of their core business. They're getting into a situation where they would have access to a potential home buyer before others would. So that has very clear value. And there are a couple of other examples in here that I think are interesting, a little on the sides of the trend, but companies like Walker & Dunlop in the multifamily space that are doing some really interesting acquisitions in the technology sector to change efficiency, to enhance efficiency, and to make sure that they're better serving customers, as well as Schwab, joint venture with a mortgage company. And I think you'll see a lot more of this sort of thing. The other thing that you see, which I touch on the next page, is that you do see a lot of companies, some of whom talk about it publicly and some of whom don't talk about it publicly, that are doing minority investments in technology companies. On the left-hand side of the page here, you see that there are a lot of residential real estate participants that are doing it. A lot of them are driven by what they say is superior insights into the industry, or a different perspective, or synergies with their underlying businesses. They say, look, some of these things, it's sort of a, keep your friends close, keep your enemies closer, a hedge to their underlying, to their typical business models. And then, look, if some of these become highly valuable companies, as growth companies can sometimes be, there's a lot of value that can accrue to shareholders without a big capital outlay. And on the right-hand side of the page, a lot of the commercial real estate companies have been much more aggressive in getting out and doing building asset management businesses, venture capital businesses, and even SPACs, which are not listed on this page, but sponsoring SPACs. So they're very active in trying to get underneath the trend in commercial real estate. And some of these are actually on the right-hand page are actually investments in residential or multifamily as well. Real quickly, and then I think we're running out of time, but real quickly, drivers of M&A. Capital or asset management businesses, or mortgage REITs trying to get at asset manufacturing businesses that with a product that has attractive risk-adjusted returns, including non-QM. Some of these guys may move away from the REIT structure in the future and become more like operating companies. I think both mortgage lenders, as were referenced earlier in the panel, traditional mortgage lenders and mortgage REITs. There are, for differing reasons, benefits of scale in both subsectors, and I think you'll see more benefits of scale, cost efficiencies for mortgage originators of M&A, and I think you'll see more of that. I think you'll see more acquisitions to try to get to customers, to try to get to the top of the funnel, joint ventures for the same reason, minority investments in technology companies, and as well as sort of those more venture-based investments. Two things to really touch on that I think are big industry trends that I think you'll see a lot more of. On the next page, I have an arrow of that continuum of, what are the products that some of the newer companies are offering to home buyers. And so you've got, I think these have grown slowly. I think they're doing more joint ventures or strategic relationships with lenders and others. They're still very small in comparison with the overall mortgage home buying market, but yeah, a lot of interest in these sorts of things. So shared equity, somebody helps you make a down payment, you get some upside interest in the home, fractional ownership, to better facilitate sort of investor ownership of properties, make that market more efficient instead of having people own and rent. Sale leaseback, if somebody needs to straddle sale of a home, purchase of another. All cash offer products, iBuying is still there. And then some of the platforms that are renting single family homes, but actually allowing the renters to go find the home themselves, they'll make an offer, and then there'll be a purchase option for the borrower or for the renter to buy the home. The last trend is, Anna mentioned it already, but is blockchain. We have not seen a lot of in-practice use cases for blockchain yet, but there's a lot of inefficiency in the residential housing and mortgage sector, and there is a lot that theoretically could be done with blockchain to make that more efficient. And that is anywhere in the process, from whether you are tokenizing real estate to the mortgage origination process and allowing faster sharing of information, to the securitization process, secondary markets, due diligence, loan participations, financing, et cetera. So I think the market will become more efficient. Pricing could become more, and risk pricing, borrower rates could be more enhanced. And I believe Redwood is speaking later today on this topic, where they've actually done a blockchain securitization. They could talk about the secondary market piece. The next 2 pages are commercial for my firm. So I don't need to go over those, but I will say we're very active in the sector. And so I and my colleagues would be very pleased if you wanted to speak with us about your strategic goals, or what you're thinking about in terms of specific transactions. And I did not go over capital raising today, and that would be difficult because it changes from day to day, but we're also happy to have those discusussions as well. So, yeah,
Thank you.
so hopefully I did not go
No,
too
no,
far
you're
over,
good.
Lauren.
You're good.
So,
We have a
yeah.
few minutes, so we'll just touch on some trends on the legal side and move forward. So we saw very strong activity in 2021. A few weeks ago, I would have said I think that will continue. I think we're probably going to see a little bit of a cooling off, particularly based on the volatility in the markets generally. We have several clients who were sellers looking to go to market and have decided to just take a step back and observe for a bit. I suspect that people will step back in cautiously as time goes on. But I do think that Mike's point about 2018 is really relevant, 2018 and 2019. That's what this feels like, is that you're anticipating volume, you're anticipating consolidation, because the cycle is flipping to the other direction. But in 2018 and 2019, we waited for that to happen. And we kind of thought there's going to be more volume, there's going to be more volume. It started to move in 2019 as there was more trends for, or more interest in non-QM and other type of products, which we're also seeing now. So I think that type of cycle shift is also good, is one of our predictions. We're seeing more interest in the non-QM products. We're seeing more interest in lenders who have the capability to do HECMs. Certainly SFR is a very popular trend, and our colleagues Hawker and others are talking about that later today on the securitization side, and how much emphasis we have seen in those type of products. Say deal structures. Jen touched on this. We're still seeing whole company acquisitions, originator, servicers, and ancillary services. I probably should have flipped that order, because I actually think we're seeing more interest on the ancillary side, and followed by servicers, and then more traditional agency originators. But if there's a non-QM originator, that would be a subset again that takes a bit of a step up. Majority and minority investments. We've seen quite a bit of interest in minority investments, where it allows the buyer to then have a pipeline to purchase product. And I think that will continue, because on either side of the cycle, we're seeing that clients like to have that access to continue to buy product going forward, and to have sort of a captive originator in-house. So I think we will continue to see that as well. MSR transactions, I thought the slide about the MSR valuation was also quite interesting. We've seen more interest in MSR funds and investments, where we've seen investment companies asking the question, how do we get into the MSR market without having to get a licensed entity? And we worked on the Ocwen Oaktree deal last year. That was an example of where we had a joint venture set up for purposes of investing in MSRs. And we've had lots of incoming phone calls on that topic. I think we might see more of continual movement in that space. Say trends to consider. Impact of the public company comps has been a shift in the last 2 years. And so many of our deals in mortgage M&A used to be purely private. And so it was a shift to have the public company comps and have those have an impact on even the private deals. We're seeing an influx of rep and warranty insurance policies too. They're actually much more useful than they were in the past. So we're happy to talk about that if you are on the buy side. And we're even seeing coverage for regulatory compliance risk, maybe not loan level claims, but regulatory compliance risk, which was a big change from 3 or 4 years ago. And I think we'll still see deal activity. I just think we're going to see a bit of a slowdown, and then I think it'll pick up again. Consolidation, again, is expected, particularly with the public companies that are out there and continuing to look at targets. But there's a bit of a valuation spread, and this is also something we saw in 2018 and 2019. It was hard to bridge the gap between expectations on the buy side and the sell side. So I'd like to turn it over to the capital markets team. Thanks, everybody. Appreciate it. Oh, yes.
One quick
Yeah,
question.
of course.
Stephen, I want to get your counterpoint. Do you think this feels like 2018, 2019, or 2013, 2014?
Well, I don't think it's 2018, 2019. I think we're in a very, very different place right now, at least in the capital markets. I mean, 2018, the Fed was trying to tighten, and markets were very concerned that they were going to go too far. The market hasn't gotten there yet, but the Fed, I think, in this case, is much less likely to essentially pull back. I mean, if you remember, it was reading, the Fed was essentially seeing what was happening in the capital markets, still saying we're going to continue marching ahead to higher rates. And then in December of 2018, all of a sudden they took a dovish bent. The Fed has a really, really long way to go on this in order to make sure that inflation comes down. So I would not be sitting around waiting for the Fed to pull back. My guess is that we are going to get.
They're going to blink.
No, I don't think they're going to blink. They have never seen inflation like this. And the worst thing that could happen to them would be to lose the market's confidence in their long run commitment to getting inflation back towards target. If they failed on that, then we've got a whole host of problems. So they can't get that wrong.
Thank you so much to our panelists.
Thank you.
Thank you.
I'm David Freed. I'm a partner on the corporate securities team here in New York and Mayor Brown. I do mainly REIT work, public, private REITs, equity, mortgage. I also work with real estate companies, SFR companies. It runs the gamut. It's real estate or mortgage loans. It's in the wheelhouse. So, yeah.
Brian Hirschberg, also partner in the New York office. Wide variety of capital markets deals, public, private. I'll let you kick it off here.
I'm Reynolds Ragersman. I'm in the San Francisco office. I'm a tax partner, so I'll provide the tax update for the day.
So we'll start today. Our panel focuses on capital markets regulation, what's going on at the SEC, and there is a lot going on, and it's coming, as Anna indicated, it's fast and furious. It's really hard to keep up with. There are, proposals coming out sort of on a daily, weekly basis. They're extremely long and in-depth proposals. Sometimes they overlap with other ones, and there is there's a lot of activity in the Gensler SEC. And with that, what we have seen is a real change in tone in the perspective on regulation of the capital markets. The former administration and the SEC under the leadership of Chairman Clayton, they really took a real focus on retail investors and Main Street investors, preventing fraud, and providing information to them on a real-time basis so that they can make well-informed decisions. The Clayton SEC was also focused on easing regulatory burdens and maintaining or enhancing investor protections. And they took an approach to disclosure and regulate and new rules on disclosure that was very principle based, and it would facilitate very tailored company specific disclosure. And we saw that a lot. You can see that in the the existing human capital management disclosures that Brian will talk about that in a little bit. But it was not a one size fits all model. And then switching to the current administration and under the leadership of Chair Gensler, what we're seeing is you're seeing investor protection, transparency, and accountability. The question is, who are the investors that they're really protecting? Are they protecting Main Street investors? Or are they protecting large institutions, pension funds? Where is the pendulum has really shifted there? We're seeing the lead up with all the ESG factors and people focused on climate and diversity and cybersecurity and human capital management, you're seeing more proposals that are trending that way. And with those themes in mind, you're seeing, as opposed to a principle-based approach, you're seeing prescriptive rules that apply to everyone. And there's still materiality that will be in play, but they are rules that don't necessarily apply to everyone equally. And you're seeing a very strong focus from the SEC in that regard. They want clear, comparable disclosure for among companies. Whether they get it from the rules, that's a big TBD right now. And you're also seeing a willingness of the Gensler the SEC under Gensler to reconsider and rescind rules that the Clayton SEC adopted late in his term. One example of that, there were amendments to the proxy rules that applied to the ISSs of the world, and they made it a little bit harder for them to claim to have exemptions from the proxy solicitation rules. But ISS didn't like them, and they've since been rescinded. There's an amendment to rescind them. There isn't a final rule yet, but there is action being taken, by the SEC to do that. So there is clearly a shift in regulatory tone, and the agenda that the SEC has put forth is it's ambitious, to say the least. The fall in December 2021, the SEC released the fall agenda. It identifies short-term and long-term regulatory actions to be taken by the SEC, and there are a number of these short-term items in the regulatory agenda that are what the SEC calls in the proposed rulemaking stage, and the items that are being considered by the SEC staff for recommendation to the SEC to act on, as well as items that have gone out the door since the agenda was was presented, and they went out the door as proposed rules. The agenda really focuses on new disclosure, rulemaking required by the Dodd-Frank Act, proxy process, and then rulemaking related to market structure, money market funds, private funds. The items in the proposed rulemaking stage at this point, include disclosure rules regarding cybersecurity, climate risk, corporate board diversity, human capital management. There are short sale disclosure reforms, modernization of disclosure relating to share repurchases by public companies, disclosure regarding beneficial ownership and swaps. They're considering rules relating to SPACs. There are rules relating to, as I mentioned before, proxy voting advice, and proposals to disclosure and conditions to, relying on Rule 10b5-1, which is an affirmative defense to insider trading liability, and then Rule 14.8, which is the shareholder proposal rule. There are proposed amendments coming down the pipe on that too, which is interesting given the fact that there were proposals to there were actually amendments that were finalized and adopted by the SEC in 2020. So it's an active regulatory agenda. As far as some of the high points of what's on there from a disclosure perspective, Chair Gensler really believes there's a need for consistent, comparable climate-related disclosure, and the staff is actively considering, and they are going to expected to present a proposed rules on climate change at the open meeting, which is coming up next week on the 21st. Those rules are probably going to require quantitative and qualitative disclosures, including data or metrics that companies use about how they're meeting any climate-related pledges and what the financial impact is of climate change on their companies. Human capital is another area that's a focus for the staff, and Chair Gensler has really voiced a concern about the need for enhanced disclosure in that regards, and it moves beyond the principle-based approach that the SEC took when they in adopting amendments under Clayton to item 101 of Reg SK relating to how businesses use their employees. So Gensler's asked staff to really focus on, prescriptive disclosure requirements, and some things that may be required are workforce turnover, skills and development training, compensation and benefits, and demographics such as diversity, health, and safety. I mean, it's a whole laundry list, and a lot of these rules are, they're going to apply to a company that has 5 employees as well as a company that has 5,000. So it's how you use your human capital if you're a public company is clearly a focus of the SEC, and they want more disclosure from everybody. They're focused on corporate board diversity, and the agenda includes a proposal to require disclosure in this regard. The rule is probably what they put forth is most likely going to look a lot like a rule that applies to Nasdaq listed companies on board diversity. Brian's going to talk a little bit about that later on. As we've heard, SPAC transactions, and the SEC is really focused on SPACs and informational asymmetries between investors in SPACs and investors in traditional IPOs. There's going to most likely be a proposal that comes out of the staff. The agenda sort of targets April of this, next month for a proposal. I don't know if that's going to happen on that timeline, but it's definitely a focus of the staff. And they're, Gensler has said that they're drafting a proposal to improve disclosure relating to SPAC conflicts of interest and dilution, among other things. We've already seen disclosure, proposed SEC proposals relating to cybersecurity disclosure, 10b5-1, and share repurchases, and we're going to get into that in a little bit as well. So we just put together a slide here that has some of the comments that have come from the Gensler SEC on primarily on ESG related disclosures and disclosure rules that they are considering and are most likely to come out to the extent they haven't already, like the cybersecurity disclosure rules. But really there is a theme here, and it's Gensler making a determination that that today's investors are looking for consistent, comparable, and decision useful disclosures around these ESG topics: climate risk, human capital management, cybersecurity, diversity. He's making a determination that this is what the market wants, and it's going to help them inform investment decisions. So that is sort of where we are on the disclosure front. Other initiatives that Gensler has, his regulatory agenda also reflects that one of his top priorities is completing Dodd-Frank rulemaking. This is probably, he was the chairman of the CFTC before he was the chairman of the SEC, and that was one of his goals there. So a lot of these rules have been proposed. They were proposed under prior SECs, but they weren't. The final rules were not adopted. 2 areas of to note here that they've reopened the comment period on the executive compensation clawback rules that came out of Dodd-Frank. Those rules were initially proposed in 2015. And it would require executives of publicly traded companies to pay back incentive-based compensation in the event that there's an accounting restatement, regardless of whether they were at fault. When they announced that they were reopening the comment period, the SEC said, we're going to take the chance to ask more questions here. And they sought input expanding the scope of the proposed clawback rules. And one of the things that's very important in that regard is they asked for comments on whether clawbacks should be triggered by what people typically refer to as a little r restatement. And so they're saying, tell us why we should or we shouldn't consider little r restatements. And a little r restatement is, it's a restatement that corrects errors in a financial statement, but those, while those errors are not material to previously issued financial statements, they would result in material misstatement if the errors were left uncorrected in the filing or if the correction was recognized in the current period. So it's a restatement, and you have seen a trend over time where public companies are no longer really restating their prior period financials, and have moved more towards these little r corrections. So the SEC wants to know, should we repropose this rule to pick this up as well? it's a very interesting regulatory approach, and using a rule that's been out there since 2015, reopening it for comment, and then saying, well, by the way, we're going to ask you all these other questions, and now we're going to, you answer these questions. We're going to, what's most likely going to happen is they're going to take the opportunity to repropose the rule, and then it'll be open for comment again. And it's just an ongoing regulatory process. The other area, they've also reopened the Dodd-Frank mandated rule on pay versus performance and the disclosure related to that. Brian's gonna hit that when he, later in the presentation as well. So the other two areas in the agenda, there's expected action on the proxy process. The SEC is really reviewing and is taking a close look at the proxy rules. As I mentioned earlier, there's the proposal on proxy voting advice, as well as potentially amendments to Rule 14A8, which is the shareholder proposal rule. And there's no details on the shareholder proposal amendments, but it's likely that they're going to, they're coming, and I think the details have not yet been disclosed, but most likely what is going to happen is the SEC is going to bake into the 14A into the rules, as guidance that came from the staff on certain grounds for excluding shareholder proposals from proxy statements. Brian's going to talk about 14A8 and what I'm referring to is it's a staff legal bulletin. It's guidance from the SEC on how to do, on their approach towards certain grounds for excluding proposals. We've also seen proposals relating to Treasury markets and money market reform. The Treasury market proposal. So in January 2022, the SEC proposed amendments to what's called Regulation ATS, which applies to alternative trading systems. And the proposal significantly expands the scope of Reg ATS. And if it's adopted, it would essentially result in increased compliance costs for brokers or banks operating alternative trading systems that trade only government securities, meaning treasuries, agencies, or repos and reverse repos on agencies. The comments, it's still in the comment period right now, and there has, but if the rules are adopted, it's likely that you could see some increased compliance costs for broker dealers to become subject to Reg ATS, and maybe expected to result in some increased funding costs for borrowers. The SEC has also proposed some new rules on money market reforms. These rules are stemming from what happened in March of 2020, when there was growing concern about the impact of COVID, the impact of COVID-19, when it caused investors to reallocate assets into cash, short-term government securities, and prime and tax-exempt money market funds experienced substantial outflows, and the outflows contributed to stress on short-term credit markets. The substance of the proposal would increase minimum daily liquidity requirements from 10% to 25%. Weekly liquidity requirements would also go up from 30% to 50%. There'd be notice filings if a money market fell below those percentages. There are other parts of the proposal that would essentially prevent people from redeeming out of money markets and creating the run that caused the outflows and the stress on short-term markets. Really the impact of this is that it could affect money market fund acquisitions of assets because of these daily liquidity requirements. They're obviously, the obligation would be to hold 2.5 times as much daily liquid assets. So they'll have less capacity for assets not qualifying as daily liquid assets or weekly. There will be some restraints on what kind of commercial paper would fit in there, repos on agencies, repos on U.S. Treasuries. So that is one area that the SEC has proposed rules, and final rules are forthcoming, subject to public comments. Okay, I'm going fast here. So 10b5-1 plans. So Rule 10b5-1 plan is a written securities trading plan that is designed to comply with Rule 10b5-1c of the Exchange Act, and any person or entity who enters into one of these in good faith at a time when they're not aware of material non-public information has an affirmative defense against accusations of insider trading, even if they trade at a time when there is, when the person or entity may be or is aware of material non-public information. The plans, the plan 10b5-1 plans have come under scrutiny from various regulators, including former Chairman Clayton, and courts and legislatures, and academics have criticized them. I mean, the focus has been, it allows insiders to opportunistically trade with material non-public information. There are various aspects of the existing rules that created some gaps that would allow for this. And Gensler and the SEC's investment advisory committee took a look at these rules and made a lot of noise in June and September of 2021. And they, a lot of those statements that were made resulted in, are reflected in these new rules. So the SEC in December 2021 proposed amendments to Rule 10b5-1 that really build upon these recommendations made by Gensler and the IAC. And the proposal would require a mandatory cooling off period of at least 120 days for directors and officers, and at least 30 days for issuers between adoption or modification of a plan and the first trade date under a newly adopted or modified plan. There would be written certifications from directors and officers stating that at the time they adopted the plan or modified it, they weren't aware of material non-public information, and they adopted the plan in good faith, not as a part of a scheme to evade Section 10b or Rule 10b5. The SEC proposal also provides that Rule 10b5-1 affirmative defense would not be available for overlapping plans for open market purchases or sales of the same class of securities, or for more than one single trade Rule 10b5-1 plan during any consecutive 12-month period. And the SEC proposal would also amend Rule 10b5-1 to expand the good faith requirement by adding a condition that the plan has to be operated in good faith, not just entered into in good faith. So you can't have overlapping plans. You can't tell the administrator to make some changes to the plan. You really have to enter into it on the front end and at a time where you don't have material non-public information, and you need to stick with the terms of the plan. The SEC is basically making, through these proposed rules, would make you disclose, you can't modify it, you can't terminate it, you can't just flip-flop back and forth between multiple plans to take advantage of different conditions, and that would allow you to buy an insider to buy at a time when it's beneficial to that insider. You're going to stick to the plan. The proposal would also require public companies to make new disclosures relating to 10b5-1 plans. There would be quarterly disclosure in Form 10Q and Form 10K of the adoption or termination of a plan, and other trading arrangement, and what the SEC has called other trading arrangements that not intended to comply with 10b5-1 plans. The SEC didn't really specify what that meant, but there are additional disclosure requirements, and these apply primarily to domestic companies. They don't apply to foreign private issuers, and disclosures would be required to include material terms of the plan. Then there would also be yearly disclosure of internal insider trading policies and procedures that are designed to promote compliance with insider trading laws. the SEC is really just taking a very, as we've said, prescriptive approach to how they view 10b5-1 plans, how they're used, and and I think what Gensler's trying to say is like, I think there are information asymmetries between insiders that are using these plans to buy and sell securities while they have material non-public information, and I want people to know about it. So in addition to these, the quarterly and yearly disclosures, you would also see proposed amendments to Section 16 filings that are made by insiders. So Form 4s would require a new check the box that would basically indicate whether a reported sale is made pursuant to a 10b5-1 plan. A lot of this is coming because most of the information about sales about 10b5-1 plans is in Form 144, and that's essentially a paper filing, right, that gets made with the SEC, and no one has access to that. So he's, again, trying to enhance transparency. The question is, who is he enhancing the transparency for? Should we turn to share repurchases?
I think so. Okay,
Here you go.
perfect. Well, thanks. So I'm going to cover a number of different topics here at a fairly high level. We have client alerts, though, diving into each one of them in a lot of detail. And on our capital markets resource page, we also have webinars covering each one of these. But continuing on repurchases, obviously last year was a significant year for repurchases, almost $1 trillion of share repurchases. The current state of existing disclosure, as many of us are aware, that you disclose quarterly what your repurchase activity was in your Ks and in your Qs. The proposed amendments don't change that at all. So the Qs and the Ks will still have to do that. What they do is they introduce this new Form SR that's essentially going to require issuers to disclose buybacks of equity securities within 1 business day after the buyback takes place. The form is going to disclose, the date, the number of shares, the class, the price, the average price paid per share, the amount of shares purchased in the open market as opposed to pursuant to a 10b-18, pursuant to the 10b-18 safe harbor, and also any shares purchased pursuant to a 10b5-1 plan. The SEC's purpose, obviously, here is to increase transparency, as David was alluding to, and provide not just the issuers, shareholders, but the greater public with transparency of what is happening for that issuer with its buyback activity. Issuers would be required to furnish, not file, this Form SR. So the issuer would not be taking liability for misleading statements on it, and it also would not be incorporated by reference into its Securities Act filings. So its registrations and statements and alike would not be incorporating this new filing. But obviously the new proposed filing would result in a lot of transparency, and issuers would have to consider their repurchase strategies in that vein, as there's the opportunity of it providing a roadmap of what the issuer's plans are for repurchases.
They'd also have to consider their plans as to what would happen if you actually are doing one, daily disclosure of this, and then you just stop, right?
Exactly.
What does that tell the market?
Yeah, what does that tell the market, as opposed to when you just quarterly disclose these kind of in an aggregate average basis? So the disclosure may impact the strategy, likely. Proposed amendments to Schedules 13D and 13G. 13D obviously is a beneficial ownership report that discloses the ownership of public company securities with a threshold of at least 5%. 13G is essentially a short form of that for certain passive investors. Under the proposal, the time periods are shortened for both of them. An investor that exceeds 5% would need to file in 5 days as opposed to the current 10 days. and amendments to 13D for material changes would have to be done the next business day. Conversely, amendments to 13G would need to be filed 5 business days after a month in which a material reportable event or a material change occurred. Currently, the requirement is you need to file it within 45 calendar days at the end of each year. So this would now become a almost monthly requirement to the extent that there is material activity. Additional proposed amendments were made to change the beneficial ownership status of holders of certain cash settled derivatives. Currently, holders of derivatives that convey a right to acquire a covered class are considered beneficial owners of that class. So think of options, warrants, convertible securities that are exercisable or convertible within 60 days. Those holders are beneficial owners, but by contrast, a derivative that just provides the economic value would not be considered under the current rules a beneficial owner. The proposed rules would change that and would provide that a holder of a cash settled derivative will be deemed to be the beneficial owner of that equity security if the derivative is held for the purpose or effect of changing or influencing the control of the issuer of those securities. The SEC also changed proposed to change the group definition as it relates to 13D filings. Currently, the group definition is fairly straightforward. If you enter into an agreement to be a group, you're a group. The proposal would make it more dependent upon the communications that you have had as to whether you are in a group as opposed to whether you've entered into a formal arrangement. Comments on all these repurchase proposed rules are due by April 11th. So we're still kind of in that comment period. Moving on to next topic, human capital management. Recent amendments were made to SK that now require, to the extent material, discussion of human capital resources in public filings. This includes the number of employees as well as any human capital measures or objectives that the REIT or its external manager has decided to focus on in managing and operating its business. The requirement, as David mentioned, came in the prior administration, so it's very principles based. But the adopting release did specify the types of information that ought to be deemed material to certain companies. For example, disclosure needs to cover any measures or objectives that relate to the development, attraction, retention of personnel. Not surprisingly, there's been a wide variety in the 10K and Proxy disclosure for how companies are implementing these disclosure requirements. The vast majority of 10Ks that we've seen include a specific diversity and inclusion subsection as part of human capital management. Very few filers break it down by race, gender, or any other characteristic beyond that, but just provide a D&I overview. The impact of the COVID-19 pandemic has also been a popular topic for human capital disclosures, covering matters such as workers' remote working conditions, mandatory vaccine requirements, work from home arrangements, hybrid, and what the plan is for that company go forward as the year progresses. In addition to the number of employees, many companies have also provided geographic breakdowns, full and part-time employee breakdowns, and type of position breakdowns amongst their employees. Other disclosures that we've seen have focused on employee retention, turnover, training, recruitment, and overall engagement. This is obviously, as David mentioned, a hot topic that there will likely be more prescriptive rules coming out in the near term. Board diversity. This has also been top of mind for not just the staff, but the exchanges. Proxies have been expanding their board diversity disclosure over the past several years. As noted on the slide, a substantial majority of public companies voluntarily disclose their racial and ethnic diversity as it pertains to their board already. And as a result, a lot of the proxy advisory firms, ISS, Glass Lewis, have been pushing other companies to follow suit and to expand their disclosure. Notwithstanding those trends, last August, the SEC approved Nasdaq's board diversity rule. So the rule requires Nasdaq-listed companies to have or to explain why they don't have at least 2 diverse directors, this being at least one self-identified female director and at least one director self-identifying as either an underrepresented minority or an LGBTQ member. Currently, we're in the transition period for the Nasdaq rule. It'll run till August. Obviously, companies that are not Nasdaq listed on the NYSE or otherwise ought to be thinking about this topic as board diversity initiatives are likely to continue. Many states are currently either adopting or considering adopting board diversity proposals. California has a diversity rule already for any public company that has its principal executive offices in the state. Currently, though, the staff expects proxy statements to cover any identifiable characteristics that the board uses to judge nominees, in addition to describing the diversity policy for the company, which obviously would touch on a lot of the racial and ethnic diversity characteristics that the board is looking to make sure is in place. But again, another area that is likely to see SEC staff action this year, so it's worthwhile, even though it may not be in time for this year's proxy, to expand disclosure proactively in anticipation of that. Next topic, so climate change disclosure. Last year, the SEC took a number of new initiatives relating to climate change disclosure, perhaps most importantly, creating the Climate and ESG Task Force in the Division of Enforcement, and also pursuing several enforcement actions against companies. The SEC also directed the Division of Corporation Finance to enhance its focus on climate-related disclosures. So public companies that have typically included disclosure in their risk factor section in kind of a generalized way may be receiving climate change comments. The staff published last year a sample comment letter with comments that were expected to be issued. Comment letters, especially pertaining to mortgage REITs, have not been very clear as far as the direction there, what the staff is looking for. But the staff has qualified their comment letters that disclosure is only required to the extent it is material. So the issuer does need to make that determination that it is material to them. That said, late last week, the SEC did announce that new climate change disclosure rules are forthcoming, and this is expected to be proposed at their meeting on Monday, early next week. So obviously, we will have a lot more on this topic early next week prior client alerts, so stay tuned there. Moving on to cybersecurity. This has also been a top priority for the staff, and just last week on March 9th, the staff proposed new rules that would constitute its first real attempt to comprehensively regulate cybersecurity and incident reporting for public companies. Obviously, the goal of the staff is to provide more transparency to the market of when a cyber security breach happens or an incident happens. The proposed rules would require an 8K filing. So within 4 business days after the company determines that it has experienced an incident, the company would have to file an 8K. So again, less principles based, much more prescriptive for companies that are having, obviously each cybersecurity incident would be very specific to that company, but they all are going to have this fairly prescriptive 8K filing. Public companies would also have to provide updated disclosures relating to previously disclosed cybersecurity incidents, disclosing any updates or any changes or any immaterial events that are deemed as material as they're uncovered by the issuer. The disclosure needs to include information on governance, the management's expertise in handling such a cybersecurity incident, and also the board's oversight of such an incident and their qualifications to remedy that all need to be disclosed. As mentioned, so this just came out last week, so the comment period on this will run till May 9th.
Yeah, I also think it's important for public companies to kind of assess what the SEC has said in the proposed rule in light of, on like real-time events that are impacting their business. To the extent that there is a cybersecurity breach, there have been recent, SEC enforcement actions that have been brought against those companies because they knew that there was a breach. They knew that it was, whether it was material or not. They didn't make any timely disclosure. And given the fact that the SEC has proposed this rule, Gensler has said it's important. There have been enforcement actions. I think public companies need to look at the requirement of the rule and assess their current disclosure practices, and not just assume that we can just disclose this in a risk factor in our 10K. It's just, this is in the crosshairs, and it's not just crosshairs from Corp Fin. It's a crosshair from enforcement as well. So
there was a case recently with First American where they were in trouble because of control environment, not the lack of disclosure.
They made disclosure. They just didn't make it at the right time. It didn't rise. They knew about it. It didn't rise to the level. It didn't rise to up the chain to people that were making decisions about whether to include that in 8K.
How would this new rule have treated that episode differently?
This new rule would require disclosure within 4 days of discovery. So you're going to have disclosure controls and procedures that make it very, that elevate the information up to the decision makers that are making decisions on disclosure control and whether to disclose or not disclose.
And even if you don't have an incident, you're going to have to describe your controls as it relates to cybersecurity. Mm-hmm. So it's almost analogous to that internal control the disclosure that was introduced, by Sarbanes-Oxley and all that kind of stuff. So it's going to be a topic.
And separate and apart, because not my area of deep expertise, but what if you're not sure of the nature of the extent of the breach, and if you disclose what it is, except you under-disclose it because you have not yet determined exactly what happened? Do you run the risk, even if you do it in good faith, do you run the risk of under-disclosure and penalties that can arise from reliance on that under-disclosure and the like?
Yes, it's a difficult situation. Yeah, exactly. It's you don't even know what happened, And so, what's that 8K going to look like? Something's happened,
And I think that it's also important to remember that these are proposed rules and there's a comment process, and there are going to be a lot of people in the various industries making these same arguments to the SEC, and hopefully they're considered.
Yeah. And that's, it's a question that a lot of people are asking.
Because the SEC's job is to regulate disclosure, not to tell companies how to do cybersecurity and, monitor cybersecurity risk.
Potential full disputes. Specifically around element and disclosures there, but will there be lawsuits around the SEC?
I mean, I think it's hard to tell, but you definitely have seen, you've seen, interest groups bringing lawsuits against the SEC for, rulemaking activity. And maybe it's maybe it's a lawsuit under, the Administrative Procedures Act or something like that, that they acted arbitrarily and capriciously and that they shouldn't have adopted the rule. With respect to the proxy voting, you saw amendments that made it harder for ISS and Glass Lewis to give proxy advice without running afoul of proxy solicitation rules. And ISS sued the SEC, and it could go the other way too for industry, for companies or industries that don't don't disagree with this. But I think it's an administrative lawsuit, right? So I think there could be, but I don't know what they, I don't know if that's the case. You have any thoughts?
No, yeah, tough to know.
Yeah.
But it'll be interesting exactly what they come
agree.
up with on Monday. I don't know how much that's going to impact mortgage REITs. I don't know that that's really where their focus is there, but.
Question is, there comes that they start. The same some previous rule. Characterize the risk that the agency under different. Very impressive. Then that's packed, and then work with changing administration and leadership. Then it's going to swing in your direction. A lot of these rules or proposals or whatever.
Yeah, I mean, you could have a seesaw effect, right? It's just going. It's what happens when you make the SEC's mission when you politicize it, and it shouldn't be that way. I mean, they should be focused on disclosure, protecting investors, making sure that companies are able to raise, capital formation, right? It's the SEC has a well-stated mission statement, and they have to, every action that they take is going to either, it's going to impact investor protection or it's going to affect capital formation. And it's a delicate balance. And, now it's become, it almost seems like this administration has politicized it, and you are seeing votes consistently 3-2. And now that, former Commissioner Rosman isn't there anymore, it's a 3-1 vote. And it is very likely to result in a process where you have one administration doing one thing and another, but you can't do it automatically, right? I mean, it has to be done through the Administrative Procedures Act. It has to be done through a rulemaking process. So I think there is real risk to it, but I also think that there could, hopefully there's some level setting and people are rational about it. What are your thoughts?
Yeah, no, I think that's right. I'm gonna quickly hit on the proxy related updates. I think the few takeaways here, obviously the universal proxy rules were adopted. This is gonna just create a proxy card with a clean slate for contested elections. This is only applicable in the context of a contested director election, not for this annual report cycle as well. So it's not applicable yet until the end of August. I think the main takeaway here too is for any dissident shareholder that wants to take advantage of these new rules, they do need to go out to at least 2/3 of the issuer shareholders. So it needs to go out to a wide base. Pay versus performance, as David alluded to earlier, the SEC reopened this comment period from what was proposed back in 2015. They didn't just reopen it though, they added onto it. So this would now expand the comp table that we're all used to in the proxy to cover potentially total shareholder return, also compared to a peer group. And then the reopening proposal also expanded the table to potentially cover pre-tax income, net income, and a company chosen measure. Obviously, this is not going to be applicable for this year's proxy, but worthwhile considering what that company measure would be in the event that this gets finally approved in the advance of next year's, as some time will have to go into that. Lastly, shareholder proposals. As David indicated, the staff issued a legal bulletin last fall in which they limited the grounds on which human capital management and ESG related proposals can be excluded from a proxy. Previously, it was a little palatable to exclude these proposals on business reason grounds, but to the extent, as was said in the bulletin, the proposal transcends the business and becomes a societal issue, then those proposals will not be excludable. There are still other reasons that they could be excluded for economic reasons and other reasons. But it will, at the very least, make it much more difficult to exclude any ESG-related matters for this year's annual meeting. So with that, I'll hand it back over to you for non-GAAP.
Yes. Not much new here. The rules are still the same. Reg G and item 10 of item 10E of Reg SK apply to the disclosure of non-GAAP financial measures. If you take a GAAP measure and you exclude an item, or exclude items that are part of that GAAP measure, you include items that are not part of that GAAP measure, then you get a non-GAAP financial measure. The SEC, has put out compliance and disclosure interpretations about non-GAAP financial measures. There have been fairly consistent comments across all industries relating to non-GAAP financial measures. The SEC is asking for reasons for disclosure of the non-GAAP measure. There have been significant comments about non-GAAP financial measure titles, including for mortgage REITs, both for commercial and residential mortgage REITs. In the last, I would say last 12 to 16 months, there have been several comments from the SEC focused on the common metric that was core earnings. And the SEC was basically asking for an explanation of why it's called core earnings if it's excluding and including realized and unrealized gains and losses. So basically, you had a relabeling, right? You had mortgage companies, mortgage REITs go from either core earnings to something called distributable earnings or earnings available for distribution. And those are, metrics that are commonly disclosed in earnings releases and periodic reports by mortgage REITs, and basically viewed as a metric that management thinks investors find helpful in evaluating performance as well as ability to pay dividends. For most of the commercial mortgage REITs are using a definition, using distributable earnings, and the residential mortgage REITs are using earnings available for distribution. I think the key difference here is really how you are classifying. The commercial guys have the expected credit losses and how they're flowing that into their distributable earnings. But for the residential, the core earnings and earnings available for distribution is essentially the same. It's just a labeling issue. That, give it to Remel.
Pass it over to you.
All right. Assuming no other questions, and so tax, unfortunately, not too many exciting developments, and the bar is low in my world. But the two things that I'll highlight are IBOR transition and something on redistribution. So when you have a debt instrument and for tax purposes you make modifications to it, and those modifications are significant, then for tax purposes you have a deemed exchange of the old instrument for a new instrument, and that can have bad outcomes or bad results to holders or issuers. And so as part of the transition away from the IBORs, the IRS and Treasury issued regulations, first in proposed form, and there was a bunch of issues with them. Then they did final regs at the end of last year. And basically what those regs tell us is they tell us what the circumstances are under which we can essentially ignore the change, and that the debt instrument will continue as it's in its original form for tax purposes. So no bad event happens. And basically what you see on the slide is the things that are blessed are replacing a discontinued IBOR rate with a qualified rate, and you can make a one-time payment. You can provide for a fallback for a discontinued IBOR rate with a qualified rate, and you can substitute a qualified rate in lieu of a rate that references a discontinued IBOR rate. That's included in an existing fallback. The regs are basically just packed with defined terms, and so I put 3 of them on the slide here. Just see, you can see these 3 are pretty intuitive in terms of what they mean. Discontinued IBOR is like a LIBOR that it ceases to be published. A qualified rate is pretty broad, anything that tracks variations in cost of borrowing. And then a qualified one-time payment is a payment that is made as part of the modification. So it's basically if you go from, let's say, LIBOR to a SOFR, and there needs to be a payment made to compensate for the change in the rate, then that's fine. The regs then say, well, there's a bunch of things we don't like. The main point of things that are not, what they call non-covered modifications, the point of it is don't do unrelated things that have nothing to do with the change in the rate. Don't try to sneak something in. So basically, if it requires consent, or you're going to try to change a different term of the instrument, or let's say the borrower has financial difficulty, and so you're saying, okay, well, I'm going to change the rates, but I'm going to, extract a payment from you. Those kind of things are, considered bad, because those things would have resulted in an actual deemed exchange for tax purposes. And so they're trying to kind of ring fence the blessed changes from the things they don't like. So that's the one topic. The other tax development is, as you probably know, REITs have to distribute their income. They've got to distribute at least 90% of their REIT taxable income in order to be a good REIT. Is one of the many requirements to be a good REIT. Back in 2017, the IRS put out a revenue procedure in which they provided for a safe harbor. And under that safe harbor, they say, well, you can make your distribution in stock and cash, a combination, as long as the shareholders can elect cash for stock, and as long as the cash component is at least 20%. So it's a way to preserve, I guess, liquidity inside the REIT. These rules apply to RICs, mutual funds, RICs as well. And so early times in the pandemic, in the COVID pandemic, so this was 2020, the IRS issued this revenue procedures 2020-19, in which the 20% cash component was lowered to 10%. It was temporary, and so now they issued a new one, 2021-53, and again for distributions that are declared after November or on or after November 1st and before or on or before June 30th of this year. can also benefit from the lower 10% threshold. So ability to preserve more cash inside the REIT. So, if Congress had passed Build Back Better Act, we would be having an hour-long fun tax discussion. But so anything else? Otherwise, I think we're at a break.
Just one quick question, going back to the IBOR discussion. So I know you talked about how moving from an IBOR to a qualified rate is fairly broad. That being said, we often get questions about folks who are exploring alternatives other than SOFR, but have this fear that even if the regulators say other things are fine, they really want you to move to SOFR. Should folks be concerned if they're thinking about qualified rates other than SOFR, or do you think what's being proposed is sufficiently broad that folks can feel okay with other alternatives?
Yeah, I mean, for tax purposes, that should be okay, as long as it tracks cost of borrowing. Like if you have a rate that let's say is indexed to the S&P 500, that'll be a problem. But yeah, if it's reasonably expected to track cost of borrowing, that should be okay. All right.
Okay, thank you.
Thank you.
We've got a lot of good information here in the housing market and public policy trends session. So I'm just going to ask my panelists to go down the line, introduce yourself and a little bit about yourself, and then we'll dive right in. Does that work?
That works.
All right. Start with you, Chrissy.
Happy St. Patrick's Day, everyone. A lot of people got their green on today, I saw,
Nice down,
so
yeah.
Represent. My name's Chrissy Johnson. I am CEO and founder of Alignment Advisors, which is an advisory, brand new, actually, company that focuses on alignment. So going beyond the idea of strategic partnerships and making it about that authentic alignment, building trust with the groups, the advocacy groups, the civil rights groups, in a way that they are equally invested in your success as they are in their own, because they care about the mission and goals that you share. I previously worked at a tiny little mortgage lender called Rocket. You may have heard of them, for a few years, leading their public policy and external affairs operation over there. Prior to that, I was at CFPB for about 5 years and in politics with a few folks like Elizabeth Warren, Al Franken, and President Obama. So happy to be here.
Hi, I'm Tanya Rakraj. I'm with Annalee Capital Management. As a mortgage REIT, we historically, our core business has been agency MBS. We also are now, we run a residential credit business as well. So we are a top 5 securitization issuer, non-bank securitization issuer. And so run a whole loan securitization and securities business on that side. And we're a growing owner of MSRs as well. I should mention, I'm a managing director at Annalee, and I head our corporate responsibility and government relations efforts.
I'm Holly Bunting. I am a partner in Mayor Brown's Washington, D.C. office. I'm in the firm's Financial Services Regulatory and Enforcement Group. It's a bit of a mouthful. I focus on regulatory compliance issues for residential mortgage lenders and other companies involved with residential mortgage loans. And primarily within that, I do a lot of work with RESPA, which I know is everybody's favorite topic to discuss. So we'll get there. And then Andrew, can you hear us?
Yep, you can hear me. I'm Andrew Ullman. I'm a partner in the public policy groups and also in FSRI. My apologies on not being there in person today, but the rain in Washington wreaked havoc on the plane schedules today. So before joining Mayor Brown or rejoining Mayor Brown, I was in the White House as Deputy Director of the National Economic Council. And then before that, spent 8 years in the Senate Banking Committee, including as Republican Chief Counsel.
Awesome. Thank you guys for joining us. And I just realized I didn't introduce myself. My name is Sasha Hewlett. I work for MBA. I'm the Director of Secondary and Capital Markets. I've been there a couple years. Prior to that, I worked in Freddie for quite a while doing various secondary roles. So, all right, let's jump in. We're going to start kind of with what's going on Capitol Hill. So we're going to go to Andrew first. There's
Sure.
a lot of leadership roles that are still left to be filled. I think we've had some progress on some, but there's still a lot that are empty. And we may have actually had, I think, some votes happen last night, Andrew, if I'm not mistaken.
Yep.
So you want to give us the latest on that and kind of tell us where we stand and what we can expect there?
Well, the old adage, in Washington is that personnel is policy, and so it's appropriate that we start off with personnel issues. And this week, there's been a long standoff over a slate of nominees to the Federal Reserve Board, and it finally was resolved this week, where you saw the nomination of Fairblue Raskin to be the vice chair for supervision, which is in many respects kind of the top financial regulatory position in the federal government. Her nomination turned out she pulled out after it was clear that she didn't have majority support after Senator Manchin indicated that he would not be supporting her nomination. That in turn, though, broke a logjam that's existed for several weeks here, where Republicans had refused to give a quorum at the Senate Banking Committee. And that's important right now because with a 50-50 Senate, the Senate rules require a quorum of a majority plus one, 50 plus 1% of the committee members to be present before you can vote out a nominee. So the fact that they didn't show up and attend meant that Chairman Brown was not able to hold a hearing to mark up the Fed nominees. So we've had this kind of stalemate for a while. And then eventually when Manchin came out and said he wasn't going to support Raskin, she withdrew, and then Toomey kind of released the hold, and they had the vote this week. And that meant Powell, Brainerd, and Jefferson have moved through the committee by comfortable margins. Powell was 23-1. Jefferson was 24-0, so which is pretty impressive in this environment. And also for this audience, important to know that Sandra Thompson also moved out of the committee, voted 13-11, so she squeaked out, but we'll get to the floor. I expect all four of them to be confirmed sometime this year. Powell and Brainerd naturally will be the first ones to move. And then frankly, the other Jefferson and Thompson will simply move once the Senate kind of has time in their kind of regular order. I mean, it's possible Jefferson moves just by unanimous consent on his own and moves faster because he has no opposition in the Senate. There's one other nominee to the Fed, Lisa Cook, whose nomination is stalled at the committee because there was a tie vote on her nomination. 12-12 means she's stuck in committee, and they'll require the full Senate at some point to vote whether to discharge her. So it's unclear path for Cook, but the other four are moving forward. And in particular, Sandra Thompson, who has been the acting chair of FHFA since the beginning, since Director Calabria was removed from office. She's over there and will continue to hold the job, and eventually she'll be confirmed later this year. So that's basically where we are. I think we still have a nominee for FHA that is still stuck in the committee. With the nominee, Ginny Mae has been in place for some time. And those are kind of the main housing finance, I think, nominees to run through real quick. I'll turn it back over to you.
Awesome. Thank you so much, Andrew. Anything else from our panelists? Or
I'll just say that we've been carefully monitoring the Fed nominations. I think some in Congress have believed that because Powell has been in an acting capacity, that holding back his nominations hasn't inhibited his ability to fulfill his duties. I'd say in actuality, Fed communications on monetary policy is one of the Fed's most important monetary policy tools. And as we know, the unspoken rule is that if you're going through the nomination process, you hold back on your public statements. So instead, we've had a range of Fed governors out there talking about the range of possible tools that the Fed can take. And it's important to have a Fed chairman who can consistently, in between FOMC meetings, provide the Fed's monetary policy stance and communicate that without concern for his nomination. So we're looking forward to that moving quickly.
One more point around the FHA nomination, because I think that's very relevant to a housing group. Putting it lightly, when Andrew mentioned the politics as usual, I think we can agree on that. The irony, I hope, is not lost on anyone that Congress voted to make permanent daylight savings time while they were super sleepy from daylight savings time. So real important stuff happening out there right now. But the FHA nomination is pure politics at this point, and it's very unlikely that she's going to be voted out of committee, which is why I'm boycotting Batman until Commissioner Gordon is a real thing. But I think the only path forward there, honestly, is going to be Senator Schumer getting her some floor time so that she can actually advance regardless of the committee vote. And I do want to put a plug for her because I think we all agree across the industry that it behooves us to have strong leadership like Julia at the helm of FHA, especially as we're advancing in this time around issues that we're going to talk about shortly around affordable home ownership, continuing to mend from the pandemic, inflation, everything like that. She is unequivocally the most qualified and uniquely able to lead in this time.
So, well, yes, a lot to keep our eyes open for as this stuff progresses. So back to Sandra Thompson, who we just mentioned, made it through with a vote from 13 to 11 yesterday evening. Since taking the role as acting director in June, she's made a slew of policy changes. Probably one of the biggest ones was suspending the portions of the PSPA agreements that limited the amount of investor and second homes that the GSEs could purchase, as well as their purchases through the cash window. So that had a huge impact. Tanya, let's start with you. Can you talk a bit about the impact that change had on the industry, and maybe any other PSPA changes we may see coming down the line or that we should anticipate?
Yes, so I would say that the suspension of the caps was expected to occur at some point. I believe FHFA thinks it makes sense for them to be able to risk manage their exposure rather than to have caps hardwired into the type of activity they can participate in. So, next, in order to provide the market certainty, the FHFA and Treasury will need to take the changes they made in the letter agreement and actually make amendments to the PSPAs. We don't actually expect that to happen right away. That may take some time for them to do that. I think important on the PLS side, which we can also move into, is what's next on the horizon around FHFA and Acting Director Sandra Thompson's announcement that they're going to do a comprehensive review of loan pricing. So, this review of loan pricing brings together, I think, two pieces, which is on one hand, what we learned from market activity when the caps were put in place, and on the other hand, FHFA's focus on access and affordability and increasing capital levels. So when the product caps were announced, it's actually quite notable how quickly the market adapted and how the private market stepped in and disintermediated that supply. This, certainly was not without friction. It's a very different process and different infrastructure that's required to move loans to the private market versus delivering to the GSEs. Yet the ecosystem figured it out, and by and large, the PLS market absorbed that supply. So you could take agency investor PLS as an example. In the years leading up to announcement of the caps, the issuance of agency investor PLS in the private markets was about $3 billion a year. In 2021, largely because of the caps, the PLS market issued $27 billion that year. I think there's two takeaways from that event. One, FHFA could have been pricing agency investor loans at a higher price, so LLPAs could have been higher on those loans, and arguably FHFA should be trying to price at a higher level or the highest level they can to maximize revenue in order to maximize the cross subsidy and in order to increase capital levels as quickly as possible. I think the other lesson that we learned from that period is that the private market will step in and disintermediate and will provide a pricing signal to FHFA as to where that equilibrium can be at. So during the caps, when they were imposed, we estimate that AAA rated tranches of PLS securitizations on the agency investor side priced back about a point in order to take on the additional supply, again showing that the private markets will find an equilibrium in signal pricing to the GSEs and FHFA. Another example is the announcement in January that LPAs on second homes and higher bands loans are going to increase for loans that are being delivered after April 1st. On the second home side, LLPAs increased as much as 3 to 4 points, depending on LTV. Even so, we expect that most of that supply is going to continue to be delivered to the GSEs, certainly in this market environment where there's a risk-off sentiment right now. again, showing that the FHFA can increase prices and that can directly impact their revenue. So this is something that we expect to have more discussions about as FHFA undergoes their pricing review. In addition, FHFA just came out with their amendments to the enterprise capital rule that requires the GSEs to hold additional capital against their assets. And so in order to maintain the same ROEs that they had prior, the GSEs will also have to, consider increasing pricing across their loan products. So ultimately, it's this review of the GSE's pricing framework that will provide guidelines for the private market as to how the private market will play around the edges of the GSE's footprint.
Oh, awesome. I think the pricing review is probably also going to tie into a lot of the mission-focused stuff that Sandra Thompson has talked about. It's very clear that racial equity in housing is going to be a main focus for her. So I think when we saw the LLPAs go up for second home and investment properties, I think maybe now people are kind of looking, well, are they going to be lower for certain things that are more core to the mission? So what do you think about kind of the pricing review and how that's tied to racial equity and homeownership and all of the goals that Sandra Thompson has in that area?
I think that's exactly right. FHFA has been clear. They provided a lot of guidance through their strategic plan, through their affordable housing goals, and the 2022 scorecard on their focus on equity and affordability. And you're right, that's going to flow through to pricing. It's going to flow through to the various initiatives looking at the mortgage credit process and likely lead to conversations and pilots around other forms of mortgage support. So on the pricing side, we do expect that this review of pricing will impact how the GSEs approach their equitable housing finance plans. Ultimately, the questions being, how is pricing adjusted? Do they provide subsidies specifically to underserved populations? And then how do they define those, the application of those subsidies? So currently, the subsidies apply to borrowers with lower credit, which doesn't necessarily mean borrowers of color or low-income borrowers. So there will need to be some clarity around the targeting of those subsidies.
Awesome. So you did mention the equitable housing finance plans. We're still waiting to see what's going to actually be in those. I think the last thing Sandra Thompson mentioned was that she really wanted to be intentional about what was in there, and they received a lot of feedback, so they're taking their time. But it's very clear that these initiatives and the focus on this in housing isn't going anywhere. So Chrissy, let's go to you. How do you think these initiatives are going to evolve and expand as this kind of important work continues? And what do you think people need to keep in mind as we move forward? And what do you think kind of is at the forefront of the agencies as we talk about racial equity in housing and closing the homeownership gap and all of that kind of mission-based stuff?
Yeah, I think you're going to probably see three themes coming out as we learn more from Fannie and Freddie and from FHFA. And again, we mentioned the mission, and Acting Director Thompson will not hesitate to remind us that it is core to the mission. So you're not going to see this as some side hustle that goes away. This is going to be intertwined into the DNA of everything that she does. But the three themes that I'm seeing surface are around collaboration, sustainability, and creativity, honestly. The collaboration, she's already demonstrated a willingness to work together across the industry with her announcement a few months ago around the appraisals and making permanent the COVID efficiencies around appraisals. There's obviously more to come out next week, actually, with the PAVE report. So it's still plenty of work to be done, but the issues around equity, access, and making sure that we're alleviating any risk for discrimination is at the forefront of a lot of that work there. I also think she wants it to be politically sustainable, quite frankly, because what she has been, you've witnessed her doing dismantling, like systematically dismantling a lot of the work that the previous administration did. A lot of that work was done without a whole lot of input from industry advocates, things like that, which is why collaboration is going to be key for her as she moves forward with these various recommendations. So political sustainability, but also sustainability for the consumer. So she's not, they're very focused on getting people in homes with loans that they can afford. It's not gonna be some willy-nilly program. Some people call them ninja loans. I call them Oprah loans. You know, you get a loan, everybody gets a loan, we all get loans. We're not going back to the dark ages there. But she wants to focus on solutions that keep people there. There are a lot of door opening solutions like down payment, pun intended, like down payment assistance and other things. But what are the issues that keep people in their homes? And that's where the creativity, I think, is going to come into play as well, because this is an age-old problem. It is a multifaceted problem. There's going to have to be a multifaceted solution. We haven't figured it out yet, and especially because it's such a deep, deep root. It's not just the tree that we're seeing, but the discrimination that has occurred throughout history. So any indicator from the Fannie report that just came out last week, the usual suspects around down payment assistance and alternative credit aren't at the forefront of that report. They were looking more so at non-mortgage costs, things like repair around the home, tax issues, property tax issues. They were talking about streamlining refinancing because a lot of their data demonstrated that refinancing does not have the same benefit for the moderate income consumers and consumers of color. And then the last one, what was it? It was the closing costs. So a lot of those issues, and appraisal is one of them that they're attacking, but there are a lot of issues at closing. So how can we alleviate some of those closing costs, not just down payment assistance to help people get into their homes? So those are things that we haven't, they've been talked about, but they haven't been at the forefront until just recently. So when she gets confirmed, I think you're going to see her hit the ground running with Fannie and Freddie and that directive, and you'll see a lot more action from them in those creative, sustainable, collaborative solutions.
And collaboration is something I know that we have noticed at MBA, just a lot more teamwork with industry when these issues come up, even, from implementation times, having them be longer, to considering pipelines and other things that, that are matter to our industry and affect not only companies, but the borrowers too. So we're seeing a lot more on the collaboration front as well. So I think that's really good. So let's shift gears a little bit and talk a little bit about kind of related topic, CRA reform. One thing we can be certain of is that it's coming. We don't know what it's going to look like in its final form, but Andrew, let's go back to you for a little bit. Is there anything that we should anticipate with regards to CRA reform at the federal level, and what kind of nominations? You may have mentioned this in your first question, but forgive me if you did, but what nominations could impact the direction that goes in?
Yeah, so this is a long saga for those of us who follow CRA. It goes back well over 2-3 years when the Comptroller of the Currency began an effort to reform CRA, came out with a proposal that the OCC adopted, but the Fed and FDIC did not. With the new administration, that proposal was eventually rescinded. All three of the agencies, OCC, FDIC, and Fed, then came out and said that they're going to work on getting a proposal out. The Fed has an ANPR out on a concept for CRA reform. The Washington whispers is that they're close and it could come even this month. So stay tuned. At core, what the regulators are trying to do is just modernize CRA to reflect the changes in the banking industry over the last 20 years. The growth of internet banking has really changed how banks operate, and the assessment process for CRA is still based around a branch model, where you look at the number of deposits that come in from a community and based on a branch, and then look at where the lending, if the lending goes in that same community. Now where we have institutions that are based in one part of the country, but get most of their deposits from different regions throughout the entire country, CRA becomes a very difficult statute to understand what the compliance requirements are. And it's also just not very quantitative. So what I expect to see is, one, some more specifics about how CRA exams are going to be conducted, both in terms of modernizing based on new technologies in the banking industry, but also more quantitative metrics. So bankers will understand if we hit these measures, we'll be satisfying our CRA requirements. You'll probably see a broader list of activities that fall under CRA. particularly in the community development area. You saw that in the AMPR that the Fed put out. I actually think the CRA proposal could be kind of the biggest regulatory rule change that we see this year out of the prudential regulators. So it's a pretty substantial change that's coming. So keep your eyes on the Federal Register and on the bank regulators.
We definitely will. And there are a lot of nuances, I guess, with regards to CRA, when you think about banks at the federal level and then non-banks and some CRA-like kind of laws that may come their way as well. So Christy, can you talk a little bit about the differences we're seeing there?
Yeah, it will be very interesting to see what happens at the state level versus the federal level. California just came out with a law that basically mimics what Massachusetts has been doing for years. And California, I mean, so goes California, so goes the nation a lot of times when it comes to state by state regulation. So I expect that other states will be picking up suit. But what it means at the federal space will be another issue. And if there's any indication from one of the lead advocacy groups, NCRC, on this issue, they put out a report, I think it was now 2 months ago, about CRA completely leaving out non-banks for the first time that I've ever seen. NCRC, usually one of their main shticks is expanding CRA to non-banks. And so as you look forward at, one of their sticking points there was an Urban Institute report that came out over the summer that identified the fact that non-banks actually are doing incredibly well in serving and providing loans to those underserved, sustainable good loans to those underserved communities. That kind of started, I think, the snowball effect of information of realizing, hey, maybe CRA is not as effective when broad brushed to non-banks, where it's a little bit more difficult to measure the footprint of community investment. So while there's the obviously lending patterns, it's the community investment part of it that gets a little bit sticky. I think there will be an interesting intersection that we see between shifting gears from CRA to ESG, quite frankly, in regards to non-bank compliance. And you will maybe see some interest from advocacy groups to work with non-banks and IMBs in meeting the S in ESG to help reach those, not just reach those communities, but invest in those communities as well. So I do think that's an opportunity for servicers to consider, especially if you're an IMB or a non-bank, as we move forward, thinking about that intersection.
Okay, and if we switch over to fair lending now, I feel like we're hitting all of these in a row. Can you give us the latest on kind of what's going on with fair lending? I know there are a lot of opportunities, or there may be opportunities to have any changes in fair lending regulation, also kind of be policy solutions as well. Can you kind of give us your thoughts on that?
Fair lending is so sticky these days. It's always been sticky. But just yesterday, CFPB put out I haven't fully had a chance to dive into it, but CFPB put an announcement around expanding UDAP more broadly to include instances of discrimination, which was not previously included in UDAP and ECOA. So that is not surprising, I don't think. I think we can all expect a more forceful CFPB right now in regards to enforcement around fair lending issues, and be prepared for those conversations. But part of being prepared, that's the opportunity that we had previously talked about, is thinking about fair lending. If you just think about it in a punitive manner, you are going to miss a big part of opportunity to work with CFPB and improve our own practices as well. So issues or opportunities around like special purpose credit programs, no action letters, those are all programs that the CFPB provides, and groups like National Fair Housing Alliance are very diligent in promoting and partnering on to help get out those pilots and programs, the pilots that you mentioned before, that help figure out how we are going to solve this multifaceted problem. So those, while it doesn't promise anything as far as evading any fair lending, like I said, punitive measures, I do think it provides a doorway into better understanding what the CFPB is going to view as the most egregious actions around fair lending, and how we can position ourselves to be better actors in the space and understand what they view as those good actions as well.
Yeah, no, that makes a lot of sense. And speaking of the CFPB, I think a big focus they're going to have on their hands in the next year or so is going to be servicing. I think we've seen servicers have kind of been through a lot throughout the pandemic, but have fared very well. I think we've run the whole gambit from how are they going to make advances? We need a liquidity facility to, okay, they're doing pretty good and we're actually in a good place now. So we've seen a lot happen with servicers over the last 2 years. So can you talk about some of the silver linings, some of the lessons learned with regards to servicing over the last couple of years? And is there anything that we need to kind of look out for or expect from servicers going forward? And we could start with Chrissy and anybody else can chime in or.
Yeah, I am so eager for silver linings right now. I don't know about you all. But I do think, never let a good crisis go to waste. There are some, again, opportunities in this crisis here. A lot of them around digitization. I mentioned appraisals already, and desktop appraiser has been proven to be effective, and now is something that a lot of that is taking hold. I think things like remote online notarization, which is going to be a state-by-state battle, but it is definitely gaining ground better than I've ever seen in the past, is going to be huge. That became very popular in COVID. Obviously, people didn't want to meet in person, and so they found a way to do the remote online digitization. Ron, our favorite ex-boyfriend, Ron, and I think that what we're learning with forbearances. So around loan modification opportunities, finding ways to streamline. One mod is a thing of the past that is coming up again. And then looking at forbearance from a different lens. There was someone over here asked before when the data god was doing his presentation around prior to the crisis, how common were forbearances. It was 0%. Obviously that spiked in the pandemic, and now that we're coming down and we are recovering. How do we look at forbearances and adverse conditions in somebody's financial life as not being indictments of their financial character? And are there opportunities to rethink how we approach consumers when they come into these hiccups, enormous hiccups in life, but that they are demonstrated, consumers have demonstrated that when it comes down to that and they're given clear communication with modification options, they just need a minute. And so while forbearances weren't really a thing before, they became a necessary solution with the CARES Act. I do think it is worth us thinking creatively about what that means for the future, and not it just being a crisis response to a national crisis like a pandemic.
Yeah, no, that makes a lot of sense. I think there are a lot of things that aren't going to be looked at the same after the last 2 years, and that's definitely one of them. So finally, we're going to pivot a little bit and talk about a topic that's becoming more and more relevant over the last few months, and that's strategic partnerships within our industry. So whether that be between builders, realtors, other industry players, it's definitely coming more and more into focus. So Holly is going to tell us a little bit about that and talk about how you can kind of prepare for that and utilize these partnerships in the future. So I think you have some slides. We're not going to project them, but they're just going to be in your
That's right.
handout.
So if you've been following along in your book, you'll find the 2 slides there from a RESPA perspective. We're not going to put them up on the screen so that you can still see Andrew. So
energy efficiency at work. Speaking of ESG,
one of the things we talked about this morning in trends is when interest rates increase, the competition among players for purchase money mortgages also increases. And from a regulatory perspective, if it makes good sense from a business strategic perspective, it's probably a violation of RESPA. So that is something, at least from my compliance perspective, that the conversations that I'm having about RESPA compliance and the types of arrangements that will work in this kind of purchase market certainly have changed. And I know we talked a little bit about real estate brokers kind of being king in a purchase market. They often are the first to see the customer. Mortgage lenders often make it a priority to form relationships with real estate brokers because of that referral funnel. And then even title insurance providers title insurance is a service that consumers probably don't even know they need or have heard of until they're in the market for a home. they're really at the end of that train. And so very much rely on those relationships to market their business. So RESPA, as I said, is not something that makes those kinds of relationships easy. RESPA, at its core, it prohibits the giving or receiving of a thing of value in return for the referral of settlement service business. Settlement service business includes the gamut. So real estate brokerage services, mortgage origination, title insurance, homeowners insurance, appraisal, essentially any service that's paid for in connection with the closing of a residential mortgage loan transaction is going to get covered under that prohibition. And it does involve a mortgage. That's another key component, is especially as we've seen some of these alternative products or other solutions for homeowners where iBuyers come in and they purchase a consumer's home. That iBuyer transaction is not a RESPA covered transaction, because in that circumstance, the iBuyer is not the consumer. The financing that they use to purchase that home is not a residential mortgage loan. So there's even some opportunities to really have to sort of pull apart these kinds of transactions and figure out where RESPA comes into play. Despite everything that you cannot do from a RESPA perspective, there are some things you can do. And the statute and the regulations are pretty explicit. They tend to really fall up under a couple of arrangements, services agreements. This is an issue that was litigated in the DC Circuit back in 2018. It was the PHH case. Most folks know that case because of the decision as it relates to the constitutionality of the CFPB, but the heart of that case was a RESPA Section 8 issue. And the court affirmed that payments for actual distinct necessary services that are performed are in fact permissible, even if there are referrals that are taking place in that relationship. So that was an important piece of a decision from the court that really emphasized what we've thought about RESPA all along, quite frankly. So you'll see that in a couple of ways. A lot of folks are interested in having real estate brokers market them. So lenders, title companies want real estate brokers to advertise them. What is the line between advertise and refer? And that's always, I think, the key part from a regulatory perspective. I like to tell our clients, if you're thinking about advertising services agreements, think about the various ways that a real estate broker can provide or display a billboard for you. So it's not the handing of the business card to the customer and saying, hey, I'm marketing for ABC Mortgage today. It's literally the display of a billboard and not that direct to consumer interaction. Of course, if you're a mortgage company, you want the direct to consumer interaction because that's what's going to actually impact the consumer. Nonetheless, these are pretty popular and they've become a bit more popular in the past couple of years. In 2015, the CFPB issued a compliance bulletin that essentially made it pretty clear that marketing services agreements were not their favorite, that they looked on them suspiciously, and they viewed them as not an appropriate strategic alliance for mortgage lenders and real estate brokers. But with the PHH decision, the CFPB in October 2020 released some frequently asked questions on their website, specifically providing guidance about marketing services agreements. So I think there is an implicit recognition that these are arrangements that can be legitimate from a services perspective. The thing, though, that's getting, I think, the most attention right now with real estate brokers is affiliated business arrangements. And this was something that was added to RESPA in the 80s that essentially said you can form companies and have an ownership interest in companies. You can refer business to those companies. And then when you receive profit distributions, those profit distributions are legal. Every day almost, I'm having conversations with folks who want to provide an affiliated business arrangement opportunity to real estate brokers. And not just the guys who own the brokerage, but the individual agents who are the top producers and who are really out there driving business. There's a lot of interesting challenges when you start inviting individual real estate agents into these ownership structures. You can do it just like any other business. These folks can put up cash capital and buy a share in a mortgage LLC joint venture and earn their profits from that. But the tendency is to think about that investment from the return on the referral, right? So if you put up enough cash capital to purchase a 10% interest in a joint venture mortgage company, but you are the real estate agent that drives 75% of that business to that joint venture, you don't get 75% of the profits. You get 10% of the profits because that's what you own. So folks think, okay, great, I'll get 10% my first year, and then we'll just shuffle the shares. You know, the next year we'll shuffle the shares around and we'll dilute the guys who aren't, making referrals, or we'll provide a new offering and bring in those that are. And then when they leave the brokerage company, we don't want to do business with them anyway. So we'll write in there that you have to leave the company. You have to be forced to sell your shares. And from a compliance perspective, those kinds of activities raise RESPA issues on their own, right? You could set up the most compliant affiliated business. You give your disclosure. You never require the customer to use it. You distribute profit strictly according to ownership interest. You've structured that business like a bona fide business, which is required from a regulatory perspective. But the definition of thing of value is so broad that it explicitly includes the opportunity to participate in a money-making venture. So just the mere fact that you offer additional shares to a real estate agent who is participating in that joint venture because they referred business last year is in itself a thing of value, and it's a violation of RESPA. So that is the challenge that I think I'm having with clients now who are looking at ways to form these relationships with real estate brokers to capitalize on this purchase money market. Is at the end of the day, what you're trying to do is incentivize people to make referrals to you. That makes good business sense. It is a violation of RESPA. And so really structuring those kinds of arrangements in a way that makes sense, that is also compliant, can be challenging. So that is definitely something that I anticipate will continue happening over the course of 2022. And people can be very creative.
Awesome. Well, thank you, Holly. A lot to keep an eye on there for sure. Any questions? I think we have about 5 minutes left. So if anybody has questions, we can, yeah.
Thank you for you, Holly. With respect to the strategic alliance framework, how much enforcement is that? Not that that should be reading. Probably does more often than I'd like to do. Have you seen it?
So that's been the interesting piece specifically with RESPA. So when the CFPB, first sort of got up and running, a lot of their early enforcement was Section 8 of RESPA. And so that really was a focus in the early years. With the change in administration, I think 2017 is the last RESPA enforcement action from the CFPB. So folks got comfortable and sort of said, okay, well, this is not a focus, so let's be a little bit more creative. My message to folks now is RESPA is not making anybody's top list of talking points. I mean, I think just based on the topics that we've talked about today, Section 8 of RESPA is not right up there with fair lending. That being said, this is a CFPB that is enforcement minded. And so to the extent that there are RESPA issues that are occurring and that get brought to the attention of the CFPB, I think you can absolutely assume that they're ready, willing, and able to look at that from an enforcement perspective. Another thing also, in thinking about their priorities from a fair lending perspective, mortgage lenders obviously are subject to the supervision of the CFPB and are subject to their supervisory examination. So to the extent that the CFPB is in there looking at them from a supervisory perspective, they're going to look at RESPA issues. And if they see them, they're going to refer them. So maybe it's a scenario where they're looking at a fair lending issue for a joint venture mortgage company that's owned by a real estate broker. Not only do they have fair lending issues, but they didn't set it up to be in compliance with RESPA either. And so now they sort of have a double whammy. So I do think there's plenty of opportunities for RESPA enforcement to be prominent. It just hasn't happened yet.
What is the view on joint marketing agreements as it relates to recapture? You've got an MSR holder, doesn't have originations. We want to refer those to the originator.
Right. So they're prevalent in the market. There is always, I think, an underlying RESPA risk with those, to the extent that MSR is being returned for free or below fair market value. The thing that's interesting with those kind of joint marketing agreements is you sort of have privacy and RESPA compete a little bit, because you need to be able to share that customer information, and you can do that under the joint marketing exception under Gramm-Leach-Bliley. But when you do that, you've essentially created a referral, right? No question that the MSR holder is referring the customer to that particular originator. So then the question from a RESPA perspective is, well, what's the entity originating that refinance? What are they sending back to the MSR holder? Is it the MSR, the new loan? Are they doing that for free? Is it at a reduced price? Is it market value? And that's the questions that come up. There's been some enforcement on that, although the facts in that enforcement action involved not only a return of the MSR, but a share of the secondary market gain on the origination of that loan, which I think those of us that live in the RESPA world, sort of view that as a lot different than your typical sort of MSR refinance recapture scenario. So the flip side of the risk, or perhaps the mitigator to the risk, I think really is in the fact that when you have an MSR holder that doesn't have the capacity to originate, they need to be able to provide a product or service to their customer in the form of a refinance. And so from my perspective, when you're looking at how to justify that arrangement, the originator in some cases is like your service provider. They're like a vendor to you who can provide that origination service to your customer. And so when you return the MSR, okay, maybe there's a risk that that's a thing of value from a RESPA perspective, but at the end of the day, it was your MSR to begin with. You couldn't offer a refinance to the customer without this originator partner. And so of course you want to get it back. So I think, that's the structure from a compliance perspective. Obviously we have the enforcement from the past. I think there's unique circumstances there. But there's risk at the end of the day.
Have you heard or gotten comfortable with the idea that quite qualifying the referral just because
So I think that's hard, and that's where I think RESPA and the privacy requirements are really in conflict, because in order to really be engaging in joint marketing, you have to be sort of endorsing or pushing the fact that this originator can provide a refinance to your customer. So it's not just the mere sharing of information, that can be done blindly, assuming that you've got authorization to do it. But it's the fact that you're trying to fall under that exception from the Gramm-Leach-Bliley Act, and you really need to be pushing that originator. So I sort of approach it like, if you're doing a true joint marketing arrangement, you just have to assume that it's a referral.
Category of sharing information, service, otherwise, and that feels better from.
Right, that's right. And of course, there's no origination happening when you share information with a subservicer, right? That's all happening in the servicing of the loan, and RESPA is only applicable where there's the origination and the closing of a new loan.
Squeeze in one GSE question before we wrap up. So I was curious, going back to the earlier portion of the discussion, right? We were always talking about one of the GSE conservatorships, 13 plus years, when are they going to end? All these steps that are being taken to get us inch us closer and closer. Time we talked about capital, which is obviously the most critical element. one lesson that you might take from the last couple of years, particularly, the use of forbearance, as Chrissy was noting, is for FHFA, the government more broadly, it's really useful to them to have the GSEs in conservatorship and essentially able to direct them to engage in crisis response as they need it. So curious for anyone on the panel, if you have thoughts on whether the COVID experience actually maybe set back the push to get the GSEs out of conservatorship because FHFA, the Treasury, the White House, or whoever is looking at the situation and saying, there's some advantages to having that involved. Thoughts on that?
Who wants to take that
We
one?
appreciate that you brought up the future of the GSEs. Usually people don't want to touch that topic because, but I know, me too. Me too. It's an important question. It should be brought up. It's administration dependent, I think. With this administration, certainly we've seen that the focus of the GSEs has shifted, and GSEs are in its mission of the administration's view on housing, the role of housing in the economy, and then equity and access and affordability. I will say that the shift in focus of the GSEs on access and affordability, this circumvents your question quite eloquently, I will say. The focus of the GSEs on access and affordability is certainly a shift from the Calabria directorship, and a lot of the important ways that Chrissy is pointing to. But I also want to note that the GSE scorecard provides equal emphasis on equity and affordability as safety and soundness. And I do think that under Sandra, she's shown that she has an equal focus on both areas, and that she herself, knows the GSEs really well, understands the role within the market, and is going to lean into the right areas on both, balancing both. In terms of safety and soundness is clearly, something she's quite interested in terms of what that means in the future state under this administration. That's something that I look forward to having more conversations about.
Imagine if it wasn't a total pendulum with every administration. And I wonder if there's an opportunity here again. I'm overusing that word today, but I really do see it as an opportunity of looking at some of the measures that had been previously put in place to inch toward that exit, and seeing what maybe we're okay with, what we're not okay with, and see, like you said, how it balances. It doesn't need to be one or the other all of the time, and it doesn't need to be administration dependent. Maybe that's a pipe dream, but but what a girl can dream, I guess.
Well said. The flip side of that, tell me what the world looks like when we no longer have 60 or 70% of the secondary mortgage market held on the Fed balance sheet.
You're hitting a great issue, which gets into the issue of GSE reform, which is long overdue. The piece that's always tricky is keeping on balance sheet as they are now. It does have some advantages, as pointed out, but the downside there is that the taxpayer takes all the risk, right? And so that is, from a budgeting standpoint, always, if you talk to the team over at OMB, they've never totally loved having the GSEs there because they're the ones who have to pay for everything, right? Now, the last, for a decade there, that was actually very good for the federal government, and that helped generate a fair amount of revenue. But from a budgeting standpoint, it does put the taxpayer in a tough position. And then the question is, what happens as you point out, do you start to see a different market rates going up, inflation's going up? What are the risks to the taxpayers going forward? That issue is likely to get, over the next decade, more attention as we kind of potentially normalize interest rates. So even though I think it's a very funny divide, though. There, on both Republican and Democratic side of the aisle, there are factions who will support the GSEs being on balance sheet, And then there are side groups that favor removing them from conservatorship. So it's actually less partisan than it looks. What is very true, and I think Barney Frank actually summed up GSE reform kind of perfectly, which is there's a overwhelming support in Congress for doing GSE reform, but there's not anywhere in Congress a majority for any particular plan. And so that's why we're in the state we're in.
Oh, I think that's well said. Any other questions or comments? If not, thank you to my panelists. This is awesome. A lot of good information. And I think there's another coffee break.
Thank you. I guess I need to know how to use a microphone again. It's been a while. Paul Jorison, I'm in the New York office. I'm one of the banking and finance partners here, and we spend a lot of time on different real estate matters, a lot of developments over the last year or two that we would love to chat about and touch on briefly today. Introducing our panelists quickly. I think we're going to lead off today with Kara Newman. Kara's on the screen, and she's with Redwood Trust, where she's a managing director, and she's head of their structured finance business over there. And Kara's been spending a lot of time recently on ESG matters, in particular on the development of disclosure standards and related topics in the world of securities offerings and structured finance. So it kind of fits into something thematic that all of us have been talking about today. And she's also going to touch a bit on technological innovation and maybe the blockchain, I think, and stuff like that. And then to my immediate left, I have Hawker Goodmanson. Hawker is a banking and finance partner in our Chicago office. He's out in New York all the time, of course. And he'll be talking about what was formerly known as the fix and flip loan, but now we call them RTLs, residential transition loans, right? Chris Cully is a consumer regulatory partner to my left here in Washington, D.C. Chris covers a wide range of, call it real estate, mortgage related topics, but today she's going to update us a bit on what's been happening with the non-QM rule and QM, because that's a big part of the market these days. And Susanna Schmidt over on the screen there is also a partner in Chicago. She does, among other things, a lot of warehouse financing and the like. And she and Hawker have been working on some novel capital markets driven warehouse financing strategies and have executed some transactions that, you know, to me are of interest. I think one of the themes that we've seen in the last few years is that products that traditionally have been on the bank balance sheet or financed basically through different debt products are now finding their ways directly into the capital markets. And then along the way, I'll talk about a couple of related product points. So without further ado, Kara, perhaps we could turn it over to you. I know we don't have slides on the screen, but Kara has some nice slides that are in your book if you have a book, and there's 4 or 5 slides in there that she might be referring to. Kara?
Thanks, Paul, and thanks very much for the opportunity to participate today. When I was putting my slides together and thinking about some topics to talk with, I was just thinking how remarkable it is that I get to talk about ESG and technological innovations on a panel with Paul Jorison, who I started working several years ago now with back before the last credit crisis. So it's particularly poignant for me to talk on a panel with somebody who taught me so much about the topic that I work in now, which is on the Sequoia platform at Redwood Trust, which is an established issuer of residential mortgage-backed securities in the super prime jumbo space. So without further ado, I thought I would spend time talking about giving an issuer's perspective on some emerging issues we're tracking in the industry. So as Paul mentioned, we've been working a lot on developing ESG disclosure at Redwood Trust. So I thought I would talk a little bit about what we're seeing in the industry and what we've been doing at Redwood Trust. And then we can talk a bit about some technology and innovations that we're seeing in the marketplace. And I can use some recent developments on our Sequoia platform as a case study. So I go to slide 98 in the materials. That's the first of the slides for this particular panel. And what I wanted to start with was pointing back to a Structured Finance Association study back in 2020 that surveyed market participants and found that while very few issuers were at that time including ESG disclosure in their offering materials, the vast majority of investors in this space were eager for data that would help them evaluate investments using their own proprietary standards. And as the bar table at the bottom of the slide shows, is that even in 2020, issuers were quite far along in developing their idiosyncratic ways of evaluating ESG attributes of investments that they were looking at. And this is consistent with what we were hearing at Redwood for the last couple of years. And that was consistent questions from our investor base looking for ways to understand ESG attributes of both Redwood and the Sequoia transactions. So I'd move on to the next slide, which has another table that was pulled from that same SFA study back in 2020 that shows a bit of color as to how investors are looking to receive ESG type information. And of respondents in that survey, you can see that there's a number of investors that were looking for ways to evaluate the collateral that was backing the transactions that they were looking at. Investors were also focused on ways to get insight into how the sponsor's business stacked up against various ESG metrics. And the bottom, the gray bar in that table shows that there's also a number of investors that are very, very curious about ways to get third-party opinions as to ESG compliance. And what this table in particular was helpful to Redwood in illustrating two different options we had when we were looking at ways to include ESG disclosure in our Sequoia platform. And a question that we spent significant time on was whether it was more helpful to, on one hand, provide raw data on the collateral that we were including in our transactions, or if it would be more helpful to, on the other hand, obtain a second party opinion that gives investors comfort that a third party has reviewed the transaction and evaluated the ESG framework set up within the transaction against a particular disclosure model. As you can see from the table on here, there are investors that are very curious in one or both of these. So at Redwood, we opted for the first alternative, which is to focus on finding ways to include raw data for investors to use. So I'd move on to the next slide, which has a number of logos of different disclosure frameworks that are in use today within the industry. So another decision point that we had at Redwood was trying to identify which framework we would use to highlight disclosure or to highlight ESG attributes of collateral that was going into our transaction. Each of these different disclosure frameworks has advantages and offers a different way to evaluate the assets, and Redwood's own ESG type disclosure points. So I'll move on to the final slide that talks about ESG disclosure. And from an issuer's perspective, selecting the disclosure model and a reference framework can be daunting. Deciding whether it's most helpful to your investor base to include raw data or to seek a third-party opinion is an important decision to make. And thankfully, we're working as an industry to enhance consistency in disclosure so that issuers are not pursuing idiosyncratic disclosure paths that make it challenging for investors to evaluate each platform on a standalone basis. Last year, the Structured Finance Association kicked off a work stream that's aiming to provide some consistency and harmonized framework within the industry. So looking at securitization specific considerations, finding a way to aggregate the most helpful, relevant, and useful disclosure topics from each of the criteria on the previous slide I mentioned, and soliciting input from market participants This initiative is looking to identify an industry-wide disclosure framework that will provide guidance to issuers on how to approach ESG disclosure going forward. So Redwood in 2021, in our 2021-9 transaction in December, first started adding ESG disclosure. We identified a number of SASB, mortgage finance disclosure topics that are, and use those to evaluate our assets supporting the transaction. We're focused very closely right now on providing SASB disclosure for Redwood on an entity-wide basis and looking at ways to identify additional SASB disclosure topics to include in our Sequoia platform going forward. It's great to have the support of this SFA initiative as we look for ways that we can continue to provide additional data to investors in our platform going forward. So the second topic I wanted to cover was just a few of the technology and innovation opportunities that we're seeing in the asset finance space. And this is an area truly where the greatest opportunity and challenges exist from an issuer's perspective. There are many, many ways that technology can be used to facilitate execution in the capital markets and to find ways to identify efficiency and bring innovation to some pretty long established ways of doing business. This is particularly true in the mortgage industry, which has a long history of reliance on idiosyncratic and often paper-based inefficient ways of transacting. So identifying ways to use things like digitized assets to increase efficiency, utilizing distributed ledger technology like blockchain to increase transparency and reliability and veracity of data, and using digital currency to potentially identify additional investors for your capital markets platform are all things that we're focused on. And it seems like not a day goes by that there is not a new announcement about an innovative technology or an innovative step forward in this space. Yesterday, there was an announcement about a partnership that will someday allow a due diligence vendor to attach due diligence reports and other data to digital loan assets on the blockchain. Ultimately, one day, hopefully this will ease what is a major time drain within the secondary market trading of residential loans, when whole loan investors need to conduct secondary diligence on loans that were oftentimes already diligenced at the point of acquisition by an aggregator like Redwood, for example. Another transaction was announced today that involved the origination of digital residential loan assets that were then transferred to the end investor via blockchain technology. I'll just take a step back for anybody who's not aware of what blockchain technology is or how it fits into distributed ledger technology. Blockchain is a type of distributed ledger technology, which is at its heart a database that's different from all other databases, and that its fundamental premise is obtaining information from the original single source of truth so that users of this database, in this case, blockchain, can rely on the veracity of the information that's recorded in a way that is permanent, transparent, and visible to everyone. So I'll take a case study from our own Sequoia platform just to highlight some of the ways that technology can bring efficiency into the structured finance space. So back in 2021, Redwood partnered with a company called Liquid Mortgage to find ways to utilize blockchain technology through the platform that Liquid Mortgage provides to increase the disclosure of payment information on loans in our Sequoia transaction. And for investors, the time period between when a borrower on a loan collateralizing a security makes a payment and investors get insight into that payment was about 59 days. So we knew that our servicers obviously collect borrower payments on a day-to-day basis. So working with Liquid Mortgage and our servicer, we established a way for our servicer to communicate daily payment information directly to Liquid Mortgage. That's then uploaded onto the blockchain in a way that's permanent and visible to all users. Since kicking off this initiative back in September of 2021, we now have 5 transactions on the blockchain with about 10,000 payments reported. And rather than waiting 59 days for visibility into payment activity, and in particular payment in full activity, investors and users of the website can now access this information about 30 minutes the day after the payment is made. So what we're seeing with Liquid Mortgage is that it actually is true that technology and things like blockchain can really enhance the speed at which information is delivered to investors.
That's terrific. Hey, Kara, it's Paul. May I ask a question? Maybe ask you to look in your crystal ball a little bit in your role on the SFA and developing the standards for ESG disclosure. If you look over the horizon in the immediate term, whatever you think is right, like the next year or two, and then maybe even in the distant future, what do you think is happening here? Like, what's the pace of change? What sort of like amount of coalescence is really occurring around standards? And in the short term, what should we be expecting, looking for reasonably? And then in the distant future, if you want to go out that far, what's the sort of outside envelope of what this group, when they really think about the potential in the future, what do people aspire to? What do people think is truly possible here? It seems like it's a big job.
I think it is. And at the end of the day, what we at Redwood are doing is essentially catching up to what we're hearing our investor base is eager for information and new ways to evaluate assets. So ESG disclosure at its heart is a way to provide additional lenses through which you can assess risk within a transaction. So the thing that excites me the most about the SFA initiative is that bringing in the best of all of those idiosyncratic ESG disclosure frameworks allows issuers and investors to open up a dialogue and identify all of the different filters through which investors find useful to assess the assets and evaluate an investment. So I think if you fast forward, a year, hopefully less, you'll see an increasing number of issuers including that disclosure in their offering materials, and ideally in a way that is consistent and uniform so that investors are able to process the information in a way that's most helpful to them.
Thank you, Kara. Perhaps now we could turn it over to Susanna, please. Oh, you want to do a question now? Sure. Kara, can you hear that question? I don't know whether we're set up.
No.
I think the question was, could you provide examples of particular disclosures in the structured finance transactions that investors are finding useful?
Sure. I'll give two different options of disclosure. So Angel Oak's transactions included a third-party opinion as to compliance with a particular ESG framework. So what that meant is that they designed a structure within their transaction, went out and presented the structure to a third-party reviewer, and in their offering document disclosed that they had obtained this third-party opinion as to compliance with a particular ESG framework. So Redwood, as an alternative, was focused on including data showing ESG attributes of loans that are backing our securities. So we focused on one particular category of SASB ESG disclosure, that's they have a number of different ESG frameworks for the different industries that SASB reviews. We focused on including data points from SASB's mortgage finance ESG disclosure framework, and included things like how LTV scores and prepayment penalties broke down between borrowers with FICO scores above and below a particular level. So that was our initial entry into ESG disclosure, but we're focused on ways to add more disclosure for upcoming transactions that will be within that SASB framework.
I think we have another question, please.
Yeah. Hey, Kara, it's Eric Kaplan. Hope you're well. Question for you on the ESG front. In discussions that you've had with investors and where ESG can and should go, you mentioned SFA's efforts. Got Dallin is sitting next to me here. Where have you had discussions with investors where they see real potential for our sector in terms of really making inroads into ESG, and where issues about impact washing can come into play, and do any of those concern you with respect to other efforts that maybe some other participants may take?
Hope you could hear that.
I'm not sure.
I'll just go ahead and jump right in. And I can say for certain that as we were framing out our ESG disclosure for Sequoia, one thing that we were particularly mindful of was ensuring that we didn't just pick and choose data that was helpful to our story, that we stayed within a particular disclosure framework, so that we were being consistent in identifying not what we presented as Redwood's view on ESG attributes of loans, but what an independent third party, in our case SASB, has identified as ESG attributes of loans. So working within that framework, we looked to see what data we had in our system and could verify for purposes of getting comfortable including that disclosure in our offering document. So there's a number of data providers that are looking at ways to develop additional lenses through which you could review data in your ASF tape to include additional data points. Again, we go back to working within a particular framework so that we're not picking and choosing attributes of loans and just calling it ESG. We're working within the confines of an ESG framework so that we're disclosing what a third party has said are relevant ESG factors. So I'm not sure if that answered the question, Eric.
I know this is a hot topic, so to speak. Any other questions on ESG?
I left.
Thank you. No? Okay. Now we will turn over to Susanna.
Thank you, Paul. And thank you, Kara. So as Paul mentioned in the beginning, my name is Susanna Schmidt, and I'm a partner in Mayer Brown's Finance Group out of Chicago, but frequently travel to New York and other parts of the country as well. The development that I'd like to focus on today, I think, is very appropriate in that in this hybrid world of in-person and remote work, my focus today is on the warehouse securitization hybrid. Obviously, that combines warehouse and securitization. Some people, I think, commonly refer to this as the single seller securitization, but just given the touch point of hybrid, I like to call it warehouse securitization hybrid. For those in the audience who are less familiar with this structure, effectively what it is you have an originator or an aggregator of mortgage loans who sells those mortgage loans pursuant to a repurchase agreement to a trust. The trust then issues a note into the market. Usually it's rated, though sometimes it's not. And what is fun about this is that by issuing the note, and if it's rated, all the better, this enables capital markets investors who are typically restricted and restrained from being direct lenders into warehouse facilities backed by mortgage loans. This enables those capital markets investors to invest in this product. From a seller perspective, obviously, there's the benefit of you have now an increased investor base which makes obviously the financing of these assets and the interest rates a bit more competitive. I think when we're sort of looking at compare and contrast and how this becomes a hybrid and works together, I think there's a few particularly noteworthy factors that I'd like to discuss. So first, in your typical repurchase agreement, you have pools of assets that are sold and then repurchased. So you have a principal balance on that repurchase agreement that frequently goes up and down. In this hybrid structure, you have a pool of assets that is sold on day one for a purchase price. That purchase price remains outstanding for the duration of the term of the facility, as assets are, in order so that we can keep the revolving nature, which is obviously salient to the repo sellers. What we do instead of repurchasing the assets is we substitute and replace assets in. And if there is ever a time where the assets are undervalued as compared to the amount of the note, the repo seller is told to contribute additional assets or put in cash so that you maintain effectively a borrowing base, which is a bit of a strange concept sometimes in the securitization market. The other thing I think to note is that these, whereas in most securitizations, the investor into securitization is reliant solely on the pool of assets and the performance of that pool of assets. In this hybrid model, the investor can look both to the pool of assets, but these are full recourse to the originator or aggregator, and sometimes there is an additional guarantor that sits on top. So you have both the creditworthiness of the underlying seller as well as the assets, which is obviously beneficial if you're an investor. Usually, these assets deals are subject to mark-to-market mechanics. However, obviously that's consistent with most repos where you have mark-to-market being performed daily, if not more frequently, by your lender into a deal. In the hybrid securitization, you usually have a third party who's performing the mark-to-market. This enables your investors who may not have sort of the technology, if you will, to do sort of the daily mark-to-markets. But it does provide a bit of objectivity, which I think sellers have found to be useful. The other factor too is we have seen over the last couple of years, repo sellers really try to push for less frequent mark-to-markets or none at all. And obviously this helps to prevent some of the volatility that we saw right at the start of the pandemic that was a bit of a cause for concern in the markets. Obviously, as the markets have gotten better and we don't have sort of a forbearance mandate, this has become less of a critical pathway, but it is still, I think, of interest to many sellers. And then the last point that I wanted to raise, just in terms of how you're comparing and contrasting these deals. So typically in your repurchase and mortgage loan repurchase agreements, these are pretty bespoke arrangements negotiated between a seller and a purchaser. They tend to look much more, when you're looking at the documentation, much more like your LSTA model, hundreds of pages of very heavily negotiated provisions. When you're looking at sort of this warehouse securitization hybrid, you're starting with the SIFMA form repurchase agreement, which is all of about 12 pages. And then, as is typical, you attach an annex at the end that goes into more of the nuanced features of the deal. However, these are not, whereas in your typical repurchase agreement, hundreds of pages, in this hybrid market, you're maybe adding on an additional 10 pages. Obviously, then it minimizes the number of reps, covenants, events of default that you have to really think through, and I think makes it a much more efficient product in terms of start to finish getting it into the market. It also, typically these don't have cross default features, which I think is also very beneficial when you're thinking through sort of seller risk exposure and how that plays out. Obviously, I think both sellers and investors have been benefiting from these, which is why we have seen these being used with increasing frequency over the last couple of years. And with that, I will turn it back to Paul.
Maybe one quick question. Oh, here we go. Thank you.
Thank you. This is Susanna, John Grevenar. Question for you. Is there an agent in the transaction that represents market investors calling faults or, sending notices? Is there someone that?
And John, you're cutting in and out a little
Yeah,
bit.
if I may, I think the question is who's representing the investors in these deals? Is there an agent or,
Yeah.
for instance, an indenture trustee that protects their interests?
Yes, so there is an indenture trustee, and this is all through an underwriter or initial purchaser. Obviously, the best source of protection is through the indenture trustee.
They typically hold a portion of the investment, or they simply paid a fee to represent the investor base?
I think the question is, does the representer of the investors have any skin in the game here so that they are incentivized to protect investors? Like, as far as I know, Susanna, but you're closer to these, I don't think these deals like structure or feature like a deal agent or like a compliance review party or a radian or something like that. It's an interesting question, though. I mean, is there a feature like that, Susanna, that has been in any of the deals you've worked on, or that maybe the underwriters for the transaction have seen some investor demand for?
Yeah, and I have not seen that feature. I think the closest that you get is you do have a custodian that is obviously reviewing, checking in files, but nothing in addition to that.
Yeah. I mean, to me, that's kind of consistent with the old school single sellers that you might recall that were all done pre-crisis, that were supported by liquidity facilities and market value swaps with, hard to believe, extendable CP that actually existed for about a decade or so. But it does seem like there's a bit of a trend these days toward having independent verification in different settings. We're working on a SFR transaction right now, if I can segue to my own little piece here. And it's going to be most of these single family rental financings that are securitizations have been done featuring a loan that basically is the securitized asset, like an accommodation loan. And the one that we're cooking on now is basically the first deal. It's going to be secured directly by real estate. And so, John, to your point, one of the topics that's getting a huge amount of attention is, well, that's great, the deal's unrated, but who's checking this huge master trust and all the data that's being provided to investors? And how is it working? Are we just posting a bunch of stuff and every investor has to fend for himself, or something else? And it's turned into something else. We're not in a place where we have like a bondholder with skin in the game at doing it, but with different service providers, at least in this space, that do a lot of diligence, like your Radians and Resolutes, on top of some special engagements of people like US Bank. There's a good amount of attention that's being paid to it. So it's not maybe the ideal model that you're thinking of that features alignment of interest, economic interest, but there's certainly a lot of attention that's gone into that, which has been great. As I touch on like the topics that I want to run through, mindful of time here, I think back before the crisis when most of what we'd be talking about, and I guess we still are in this room, is first and second lien mortgage loans. And then the crisis comes along and there's a buying opportunity, and some of the private equity guys like Blackstone start the single family rental industry, which in a sense is a lot like multifamily, except it's always been hard to do because single families spread all over and it's easy to manage, so to speak, an apartment complex. But how do you manage 1,000 homes that are spread all over, say, Fulton County and Georgia or something like that? And so once people started to crack that code and build sophisticated property management outfits, some of whom, because of the amount of construction they do now, are the equivalent of the largest home builders in the country, just the SFR property management arms of some of these big players, kind of the code was cracked. And so now one way to think about this, in my brain at least, is on one end of the spectrum, you've got mortgage loans as being kind of interests in real estate, so to speak. And then you've got people that really own the dirt, the residential real estate, and they rent it out. And then in the ensuing like decade or so, we've seen this incredible proliferation of products along that spectrum. You end up with like an iBuyer. Well, it's iBuyers, these Zillows and OfferPad and Open Door. They're not buying to hold like SFR, holding and renting and levering and creating effectively a coupon, a levered coupon for their investors. They're buying and reselling and using very sophisticated technology to do it. And then you've got guys like Home Partners of America and their and Divvy and others who are basically buying and offering the renter an option to buy, yet another place. There's other people who will buy the home from you and lease it back, like an Easy Knock. And then there's other products that we're seeing just the beginnings of now that basically are fractional ownerships in homes. And so you can be an occupant of a home and own 20% of it, and call it the institutional investor owns 20% under some sort of joint ownership arrangement. And then we've got the home equity contracts, which are basically a few deals that have been done this year, and there's several outfits that have been in this space for a decade or more. Literally an option contract that typically gives a homeowner a piece of money, say $100,000, interest-free, for maybe 10 years until the option terminates. If you sell your home, you pay a share of the appreciation plus the $100,000 back. If you sell your home and you don't make money and there's no profit, you just give the $100,000 back. So, it can be an interesting thing for a consumer that's kind of in a tough spot to basically be able to, I won't call it borrow, but to take advances on their future appreciation of the equity in their home, clean up their credit score, and put themselves in a position where they can either cash out that option or, protect their credit. So all of these new products have been, I think, fascinating to watch develop, and they're creating all sorts of new financing challenges in the capital markets. And I just think it's been something that, for a lot of the participants is creating new growth and excitement. And then the marriage of these products with technology has been also a source of terrific growth. So as we look at what's happened in the last year or so, the amount of capital, for instance, that's coming into the SFR business, I think is extraordinary. As different investors are looking for yield, and obviously you can lever up the net rental income, but the other more esoteric products are seeing a huge amount of interest too. And so, in the absence of some of the deeply concerning developments that we've had recently, which kind of loom over the horizon, heretofore had been, very interesting market and a lot of fascinating product innovation in the last 2 or 3 years. I think with that, one of the new products that we'll get to eventually is the RTL, but I want to talk about or ask Chris to talk a bit about the non-QM product, because it's been around for, I don't know, several years now, continues to grow. It represents an important source of credit for a big slug of homeowners who aren't able to avail themselves of traditional mortgages.
Thanks, Paul. I'm Chris Cully. I'm from the DC office of Mayor Brown, and I'm largely a consumer compliance related attorney. So I'm going to come at it from that perspective. We've heard a lot about non-QM today. We understand why it's such a big focus. We're looking for underserved markets. We're looking to tap into innovative underwriting. So I wanted to give you a quick update on just where we are, what is a QM, and what I've seen. So as a quick status update, obviously non-QM is a label, and it means that these are loans that are subject to the federal ability to repay rules that do not fit within the qualified mortgage boundaries. So what are the qualified mortgage boundaries? And right now, that's a bit more complex of an answer than it has been and that it will be. And I put some just kind of brief factoids on the slide because we're in sort of a transitional period. There was a new final rule in December 2020 that established this new definition of QM. You've all seen it. It's APR based. A loan that doesn't hit that threshold is a QM, so long as the originating lender considered and verified documentation. It doesn't have any of those product restrictions that we're used to. So we have this price-based QM. And that came in, let's see, that became effective March 1st. So lenders could begin originating QMs under that definition at that time. But the CFPB wanted a transition period. The period was initially July 2021, but they extended it till October 1st. So until October 1st, lenders can still use what I call the old QM definition, which, as you all know, is a 43% DTI loan underwritten in accordance with Appendix Q. So we could still do those. Those are still QMs until October 1st. Interestingly, and we talked a little bit about some of what Fannie and Freddie can do. For a long time, Fannie and Freddie were the big source of the marketplace, and they had this QM category that essentially related to loans that exceeded that 43% DTI. They called it the patch. It was there so that the marketplace could get used to a post-crisis period. It was intended to sunset. That was about the time the CFPB started its rulemaking. So the CFPB said, we'll just extend this patch. It applies to any loan that the GSEs are eligible to purchase. We'll extend that while we're doing our rulemaking. They did that, and it's extended through the same date of October 1st, 2021. That's what CFPB says about it. But as we heard earlier, the FHFA and the Department of Treasury have been tinkering with the preferred stock purchase agreements and indicated that starting in July, the GSEs are not able to purchase the old QMs anymore. The loan has to meet the new QM category. So it has to meet that APR category in order to be eligible for purchase. So in a sense, there's no longer this kind of patch QM category. So if that's not kind of confusing enough, I guess it'll all get a little bit clearer in October when there really is just kind of one set of QM definitions. So that's what a non-QM is. It's anything that exceeds that APR threshold. You still, lenders still have to underwrite these loans. They still have to consider and verify income or assets. We've seen originators go at it in a couple different ways. Either these are borrowers who are kind of near miss borrowers that can't quite fit into the QM boundaries. They may be high net worth borrowers who want to rely on their assets instead of having to necessarily document their income. You could take advantage of the terms that come along with having a balloon at the end or interest only payments. So those are what I've kind of seen in the non-QM marketplace. But I'll remind you too that there are loans that aren't covered by the ability to repay rules. So we've seen debt service coverage ratio loans, investment purpose loans. And I've seen some interest even in community development financial institutions. These are institutions that get certified for a particular purpose to serve a particular community, and their loans are not subject to the ability to repay rules for obvious reasons. They've subjected themselves to oversight so that their kind of creative underwriting can serve a public purpose. I don't know how many folks have gotten too far once they see the regulatory requirements. Sometimes they go away, but I definitely get lots of questions about, can't I just do this CDFI thing? So you'll recall the deal with non-QMs is that they don't get the benefit of the safe harbor of compliance. So what is the legal risk and what have we seen? What kind of litigation or enforcement have we seen? And the answer is not really much. Haven't really seen too much. There were a couple of supervisory notes from the CFPB over the years. There have been a couple of cases I've seen that where borrowers have tried to assert that the lender did not reasonably determine their ability to repay, but they were pretty narrow cases that didn't really give us much information about what courts may do with, with this regulation. And that's not really very surprising. The volume of these loans is somewhat small, growing, seasoning, forbearance. As we mentioned before, there've been a lot of efforts to try to keep borrowers in a place where they're, number one, not facing the situation where they want to go out and hire an attorney to sue their lender. And the CFPB has really been focused on a lot of other priorities. So there's not a lot really out there to tell us what it could look like. All that could change, and we could see more of that in the future. I'll hand it back over, but one other thing. So qualified residential mortgages, QRMs, these are the set of loans that are exempt from the credit risk retention requirements. Just a quick note that the agencies that are responsible for defining that have kept those definitions aligned. They had a self-imposed review period. They did that review. They talked to the CFPB and it decided to continue that those definitions should align. So sort of a non-news, but I thought I'd at least put the cap on the QM bottle for now. So that's it.
Thank you, Chris. I know a number of folks in the room here have spent a huge amount of time thinking about the non-QM and QM policies and the like. If anyone has questions or comments or thoughts you'd like to share with the group, please feel free. In the absence of that, Hunker, maybe I can turn it over to you, please.
Yeah, hi everybody. My name is Hawker Goodmanson. It's really nice to see everybody here today. So thanks for stopping by. I wanted to talk a little bit about fix and flip securitizations. And I think that for the last, 3 to 4 years, we've seen a kind of a pretty active market and fix and flip securitizations, and that kind of seems to remain pretty strong through today. And I've always thought that those were kind of interesting transactions if you think about them from a kind of a securitization perspective, because I think traditionally when you think about securitizations kind of in the mortgage space at least, that they're pretty passive vehicles. You stick a pool of loans in there and you wait and let them pay off, and then you just go about your business. Whereas the fix and flip loans obviously have a lot shorter duration than your traditional, consumer loan. And investors typically want, they have, say 6 to 9 months to up to 2-year maturity, whereas investors, like to have their money out for longer than that. So they have a revolving feature. And Paul and I were actually talking this morning that realizing that revolving features in kind of mortgage related securitizations are getting increasingly common. We're seeing it in the fix and flip space. We're seeing it a lot in EBO securitizations, both in the forward space and the HECM securitizations. Whereas I think traditionally, up until a few years ago, it was kind of mostly kind of HELOC deals that had some kind of a revolving feature to them. And revolving pools are tricky in mortgage securitization because it's hard to tranche bonds that are secured by mortgage loans without putting them in a REMIC. And revolving pools are not REMIC friendly, or REMICs are not revolving pool friendly, depending on how you look at it, because you can't really add assets after you set them up traditionally. And so I think that these traditionally today have been done as, I guess, one of two ways, either as debt, straight debt for tax deals, where you kind of have to, if you're doing tranching, you have to break the relationship between the subordinate tranches and the income on the loans usually by trapping cash. Or if you have kind of aggregator platforms, they can sometimes issue offshore and tranche that way. But that's, I think, a feature that is kind of indicative of or a key feature of these deals. And you see a lot of different ways of how the pool revolves. You obviously will use excess cash, excess principal, or principal collections during the revolving period to acquire new loans and to fund, unfunded commitments. You'll have a pre-funded acquisition account sometimes, and you might have issuers that, when they're ready to securitize, don't really have enough product to fully fund the deal, and so you might see a large portion of the deal collateralized with cash on day one. We've seen some people use kind of BFNs that are layered on top of the term notes to help with cash flows for funding and acquisitions. And we've even seen deals where the investors in the note agree that they're going to participate in an upsize later if that requires. So there's a lot of kind of novel ways to deal with that in the structure that you don't typically see in kind of more traditional structures. And then you, particularly in the aggregator platforms, you'll have some pretty basic acquisition criteria, but they're very basic, and there's a lot of reliance on the sponsor to manage or select loans to be added into the deal, but with very basic criteria. And if the criteria for adding assets are basic, the criteria for selecting new servicers are even more basic. I think typically, the standard is the servicer needs to service in accordance with applicable law and somehow get the cash to us at some point. So there's I think a distinguishing feature, I think, of these deals is that there's a lot of reliance on the manager or the sponsor to be careful in signing up new servicers, asset managers, and buying assets. And kind of to John's point earlier, there's not really anybody typically that's looking out for that, and people are just relying on the equity that the sponsor hold, which in fairness is usually pretty substantial. And then I know we're coming up against our time here, so I'll say one last thing is that I mentioned earlier that REMICs are tricky, and I think there was a deal that closed last week that used a REMIC. So we might be seeing an increased or a move towards getting comfortable with REMIC structures. And there was kind of a novel approach to adding assets into the REMIC that does have some kind of operational burdens. There's going to be a lot of tax returns to be filed potentially, but we'll see how the market responds to that, and if the tax bar more in general gets comfortable with that approach. But that's I guess something to keep an eye on those transactions. So Paul, I think that's
Thank you. I think that concludes our program.